This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Start of a new week. This is a Monday morning, and one hopes that the sentiment with which we closed the market last Friday continues into this week as well. I'm Prashant. With me, my colleagues Sonia and Nigel. Guys, good morning.
Hi, good morning, Prashant. Good morning, Nigel. And we have so many cues to track, right? Of course, there's Reliance earnings later in the evening. There's HDFC Bank that we have to react to, and a slew of earnings this week. So we pretty much have our hands full.
Well, that's right. And we have expiry as well that will play out. So, plenty of action this week.
Plenty of action, actually not plenty of action over the weekend, which is good news. You don't want rockets being fired, and we didn't get that, and I think that's what I want to start with, really, and that's what did not happen is what you need to know, and I think that'll be important. So, markets in the US sold off, and I'll get to that in just a bit on Friday, but there's a sigh of relief this morning. And the sigh of relief is largely on the back of the fact that there has been no geopolitical escalation over the weekend. We were saying this on Friday after the post-market show on Editors Roundtable that most of the escalation actually has happened over the weekend. From the first incident to the second retaliation, to the retaliation, to the retaliation, everything is largely coalesced around the weekend. So nothing happened, and I think that's good. So we are seeing a familiar pattern of markets being supported from the open. What do I mean by that? I mean, if you look at the US equity futures, they're up about 0.3 to 0.5%. It's a slow start, but that's where we're at. You've got Treasury futures. I mean, if you look at the 10-year, for example, the implied open is about 1 to 1.5 odd basis, 2 basis points higher now on the 10-year. I mean, it's, yields in a risk-off kind of environment, yields would be sold, bond prices would go up. It's a reverse right now, which is not exactly a bad thing. Now, of course, I mean, you could go on the other end of things and talk about higher rates, higher for longer. We'll get to all of that in just a bit. But since top of mind, the big concern has been geopolitics, and nothing has happened. I mean, at least at the margin, incrementally, we will take this as a bit of positive. You also had the BBC, which essentially said that the Iranian president's Friday speech did not mention the most recent events. And both sides have kind of climbed down. One side, of course, saying that no damage was caused. The other side not really going all out and saying, well, we did a lot of damage. And indications are that they don't want any escalation. On Friday, and this is, of course, I mean, the reaction to the most latest events, which did not happen. But on Friday, we didn't know this, right? So US market sold off. NASDAQ was down 2%. S&P was down about 0.9% as well. And this was largely because things were uncertain in terms of how things were looking going into that Saturday. Now, the 10-year is around 4.62%. It's flat. The dollar index is flat at about 106, a little over that. And oil prices are also flat at about 87 or so. So, we've seen a worse kind of combination over the last many days. And this is not the worst thing. Friday, of course, here in India saw a massive rebound from the lows, something which we were talking about. That entire rally was retraced. We had a 1,000-point up move, and then we had a 1,000-point down move. The Nifty touched almost got to 21,700. And then that means that, plus 1,000 became minus 1,000. And from there, we saw this 400-point rally from the day's low, and the Nifty Bank, which saw a 1,000-point move from the day's low. What are the targets now? We're looking at stuff possibly and hopefully on the upside. The immediate target would be 22,276. So you're looking at retracements from the top, retracement of the 1,000-point fall from the absolute high to the low, and this 50% retracement stands at 22,276. That's the immediate number, about 150 odd points away from where we are. It's not going to be very easy and one way. I mean, remember that, because in this region between 22,250 to 22,500, it's also a big gap area, and expect resistances to start to work. But I think eventually we start to look at those numbers on the upside. Targets for the Bank Nifty stand at 48,110. It's a similar retracement for the Nifty Bank as well from the high to the low. The 61.8% stands at 48,110. The Nifty Bank did not do as well on the upside, and it's not fallen as much on the downside as compared to the Nifty. So these are two levels for the Nifty Bank. Actually both for the Nifty Bank and for the Nifty, hopefully we will not break the lows that we saw for the Bank Nifty, that is 46,579. it's an important week for earnings. And I think, actually more than anything else, the US market is looking a little tricky. It's broken it's broken the 55-day moving average on a weekly basis. And in the past, go back the last 2 years, that has given you about a 4-5% kind of a correction. So, but, could something change? Earnings could change that. We got, 4 of the sort of magnificent 7 companies which report earnings this week. Overall, 40% of the S&P 500 companies also report. So there is a lot to track. GIFT Nifty will come up on your screen. And it'll give you an indication how we're likely to start 150 points higher. So we'll take it from there, Sonia.
Oh, absolutely. I think it's going to be a really strong start, right? That's what the GIFT Nifty is indicating. And this strong start is predicated on a few things. One, of course, is HDFC Bank's numbers, which didn't have any major negative surprise. The earnings were largely in line with expectations. The margins have actually improved a tad bit quarter on quarter. It was a little bit of a mixed bag as well because, there were some negatives in the numbers as well. But most brokerages are bullish on the numbers post what we saw over the weekend. Goldman Sachs, in fact, has raised their target price on HDFC Bank to 1940 versus 1915 earlier. I think the fact that there is no major negative surprise is something that the street has taken with both hands. You have Reliance's numbers later today. They come out post 7 o'clock in the evening, so we have a long day ahead. The street is expecting a strong performance, especially in the core business because of the way oil prices have moved and stability in the telecom business and retail as well. So that's another big trigger to watch later in the evening. And I'm watching out for mid-cap IT very closely at a time when, results from Infosys, Wipro have been very lackluster. Look at Persistent Systems, right? Overall, for the full year, they've seen a 14.5% growth quarter on quarter and good performance sequentially in Q4 as well. So at a time when larger peers are lagging a bit, Persistent Systems actually doing pretty well. So I'm watching out for that stock. Now, the global markets, this morning Asia is looking good, but the US was not that great. The Nasdaq, in fact, has been down for 6 straight days. But if you look at the flows as well, they've thinned down a bit for our own market. So DI has barely sold 50 crores. FI has bought about 129 crores. But it's an important week of earnings. We kickstart with Reliance today. And then we have Axis Bank, Bajaj Finance, HCL Tech through the course of the week. So a lot of numbers coming through. And we're going to analyze it threadbare for you. But the moot point is this, right? The market has been very strong. And the Nifty, in fact, closed above the 22,100 mark on Friday. The Nifty is now up 300 points from the 19th April low that we hit. So we are sort of seeing every dip getting bought in this market. And another big positive, apart from what Prashant spoke about, which is, the cooling off of tensions between Israel and Iran, is the way Brent crude prices have also cooled off. The Brent is now down 3% in the last 1 week. So a lot of positives for our market, and maybe we can build on to that momentum today.
Well, that's right. The volatility is going to pick up in this week itself because, as I mentioned earlier, there's expiry week as well that will play out. So towards the end of the week, second half at least, you'll have quite a bit of volatility. So that's one factor. Besides that, we saw a good recovery in Friday's trading session, but those key resistance levels, they remain elusive. And with the gap up that we're going to be looking at, we're going to be starting pat in those levels. So we'll need to see some follow-through buying from here on. And the third point that I'm looking at is that, in fact, global cues, they're a little bit muddled. So we're looking at, the big names on the Nifty. HDFC Bank's numbers, well, they were par for the course. But I think the numbers are not something that will drive the stock higher. Maybe that MSCI rejig, whenever we get the outcome out there, that's going to be the key trigger for HDFC Bank. And Reliance Industries, been in fine form, protected technical levels as well, the 2,920 odd level, which we have been mentioning earlier. It's been bouncing off that mark, 2,900 odd. So that's going to be the key trigger to drive us higher from here on. What do the FIs do? Well, after a while, after 4 sessions, they went ahead and they bought index futures. And if you look at it in total number of contracts, well, they added close to 25,000 long contracts, while they added 20,000 short contracts. Keep in mind, they continue to remain net short with close to around 65% of their positions on the short side. In absolute terms, it's still at more than 1 lakh contracts. So the FIs, they're still net short. If you get some glimpse of good news, well, you could see a short covering bounce. And we made this point even on Friday as well. So a net short market is actually a blessing in disguise. Let's look at the options data then. I picked up 2 strikes that have a fair bit of open interest out there. The 22,000 put on the downside, and on the upside, the 22,500 call. And that's going to be really the most important strikes that we'll be looking at for the next few sessions. And just plugging in the numbers, going by the options data, the sense you get is 22,300 to 22,500. That's the important resistance mark that I'm looking at. I'll validate that. I'll say because the DMA comes in closer to this 22,300 odd mark, and the options data is suggesting that that 22,530 becomes a crucial mark. On the downside, well, we protected the 100 DMA, so that's going to be an important resistance level, a support level. And even in Friday's trading session, you did see that low. So, that's the crucial zone you're looking at on the downside. What about the Nifty Bank, the largest component in there, right? The 20 DMA, well, that's the important mark where we ended in Friday's trading session. And that's the reference zone on the downside. Stocks that I'm looking at besides the larger names, well, a few technical factors playing out there towards the end of the series. Some of these stocks have come out of the F&O ban, so expect some bit of action on these stocks as well. I'll keep an eye out on GNFC, Hindustan Copper, as well as Nalco. So the start in the green, need to build down from there and break those resistance levels. Guys.
All right, Nigel, thanks a lot for that. So it's promising to be a good day for the equity markets. Let's see which way it goes. We have so many cues to track. First up, we begin the day with a comment from Chetan Seth of Nomura, who says that after the hot March US CPI print, they have been warning of near-term risks for Asia ex-Japan stocks from the triple threat of sticky US inflation, high oil prices and a stronger US dollar. However, he says on a multi-month view, they remain modestly constructive on Asia ex-Japan stocks, still expecting a resilient US economy, a strong Asian earnings recovery in 2024 and a modest cyclical recovery in China.
Okay, well, let's get you some money market views now. B. Prasanna of ICICI Bank says that the dollar maintained dominance driven by heightened geopolitical risk and hawkish commentaries by Fed members after a spate of strong data. He says currency market volatility has increased, especially against Asian and emerging market currencies, which have weakened or recovered depending on the geopolitical chatter. He says the rupee is strongly supported by the RBI intervention and is expected to remain in the range of between 83.25 to 83.75 to the dollar in the coming week.
All right, and on the bonds, V. Prasanna says the bond yields across the globe continued higher with intermittent retracements owing to risk-off sentiment emanating from geopolitical risks. He says crude oil is also consolidating at higher levels and local bond yields rose in sync despite lower supply as the repo rate cut expectations are getting fully priced out this year. He expects cautious momentum to prevail with the 10-year benchmark bond yield likely to trade in a range of 7.15 to 7.25%.
Ed Yardeni is with us, President at Yardeni Research. Ed, good morning. Good to have you with us here. Prashant this side. The US indices look a little weak, technically speaking. They've broken some averages. Do you expect a 4-5% kind of a pullback for indices from here?
Well, we're down 5.5% from the March 28th peak for the S&P 500. I think that we could go lower. We just last week broke down below the 50-day moving average. And then the next stop might be something in the neighborhood of 4,800, which might find support at that previous all-time record high that we made way back in January 3rd of 2022. And if that doesn't hold, then it'll be more like 4,700, which is the 200-day moving average. And that would be a full 10% correction. So I think we could get a full 10% correction on this. I think the market's going to hasn't completely discounted the fact that we'll probably get no rate cuts by the Fed this year.
Okay, no. Sorry, what did you say? You're not expecting any rate cuts by the Fed this year, correct?
I'm not.
Okay.
I think at this point, the Fed was disturbed by the hotter than expected CPI inflation numbers during January, February, and March. And now we're getting to the political season. So I think they probably won't do anything until after the election, which would put them at the November and December meetings. But I think the economy is going to continue to do well.
Okay, so if that's the base case, right, Ed, that there is no rate cut this year, and which is the common narrative now, how are you approaching emerging markets like India? Because that seems to be the case here as well. Growth is good, things are picking up, but we are heading into a huge election season. So how do you approach the equity markets now?
Well, India's had a tremendous move in the stock market. The Indian economy has been doing very well. A lot of investors have already discounted the fact that China is not doing well. And as a result of that, some of the benefits of that are actually going to India. The election result, I think, is pretty well anticipated. And the government, if it remains in place, has promised to make India the third largest economy in the world. So, they're certainly talking a bullish scenario for the Indian stock market. But on the short-term basis, I think there's a possibility for the 10-year bond yield in the U.S. to get up to 10%. There's a possibility for a full 10% correction in the S&P 500. And meanwhile, the dollar's strong. So those are not conducive to emerging markets generally on a short-term basis.
Hi, Ed. Good morning. I recall in the past you were talking about the S&P 500, I think, approaching that 5,400 odd mark. If we do get the other 4.5% correction that we just spoke about, that completes the 10% correction, what could be the year-end targets then on the S&P 500?
It'd still be 5,400. On March 28th, when we got to almost 5,200, 5,300 on the S&P 500, people were asking me if I was going to raise my 5,400 target for the end of the year. I said, no, I think the market needs a pause here. It's discounted a lot. The valuation multiple is awfully high. I think from here on, we have to have an earnings-led market, which I think we will. But I think it's going to be a more gradual ascent. We've had a melt-up, really, from October 27th of 2023 through March 28th of this year, and I think it's time for a pause.
We have these large companies, the so-called Magnificent Seven. 4 out of the 7 are reporting numbers this week, Ed. Tesla will report on Tuesday. I put out a piece on Friday looking at not just Tesla, but the general slowdown that EVs are seeing around the world, at least the big important regions around the world, be it China, Europe, US, etc. By the way, Elon Musk was supposed to be here in India. He was supposed to be here on Sunday, and then was supposed to be in the PM on Monday, but of course that's been deferred. Just a quick thought. It's it used to be at least an important indicator for the market overall before NVIDIA took that charge. What's your sense here, Ed?
Well, I think, Tesla is clearly viewed as a technology company, but it's also a car company. And the car company is a different kind of business than a semiconductor business. But I think Tesla is not quite as magnificent as it had been. We're also seeing that NVIDIA has given up a little bit of its meteoric rise. The Magnificent Seven, they're not all that magnificent. They had a bad week last week. Amazon basically was the only stock that outperformed the S&P 500, and it was still down a little bit. I should say Google was the only one. Alphabet has another name for it. But I would say all in all, they are growth stocks, and growth stocks do tend to underperform when interest rates are going up, which is what they've been doing.
All right, let's see how this plays out, right? Tesla has gone ahead and cut prices in China and in the US as well, and we've seen a steep fall in their sales. They've laid off 10% of their global workforce. So things are getting pretty ugly over there. But Ed, thank you so much for stopping by and speaking to us at CNBC-TV18. Appreciate your time here. Have a great week ahead. Let's slip into a quick break. When we come back from the break, we have our entire research team joining in to help us with the list of top 10 stocks. Stay with us. Okay, we begin the day with positive cues. Looks like it's going to be a very strong start. But one stock on everyone's radar is going to be HDFC Bank. Post its numbers. Abhishek is here to give us the fine print. Abhishek, good morning. How did the numbers look?
Well, Sonia, they've actually surprised positively to the street expectation, especially on net interest margin, which was expected to be flat or decline sequentially as per analyst estimate. But net interest margin has improved on a sequential basis by 4 basis points, and also they've built a buffer in terms of provisioning from the stake sale in HDFC Credila. So net interest margin has improved to 3.44 versus 3.4%. They have made provisions of 10,900 crore from the stake sale money in HDFC Credila and the tax write back that they have got. LCR or liquidity coverage ratio has improved to 115% versus 110% in the previous quarter. Asset quality has also improved. Gross NPA ratio is down 2 basis points on a sequential basis. HDB Financial, one of the subsidiary, has reported the lowest gross NPA ratio in last 18 quarters, coming in at 1.9% versus 2.25% in the previous quarter. On the flip side, the risk weight to advances, that ratio continued to jump up for the second quarter in a row. It's now at 99.3% versus 97.6% in the previous quarter. One-offs, they had a one-off in terms of employee expenses of 1,500 crore, which they have rewarded their employees as per the con call that management did mention. A provision buffer 10,900 crore made from the stake sale in HDFC Credila, as well as tax write back. So in terms of PNL versus poll, NI is ahead of our poll, PAT is below our poll. Back to you.
Okay, all right, Abhishek, thanks a lot for that. Well, the street was sniffing a better than expected number. It seems the stock ended at the high point of the day on Friday. Well, let's talk about the other big name from the tech space. Rima joins us to tell us about Wipro. Rima?
Hi, good morning. So Wipro Q4 is in line with expectations, but they've disappointed the street in terms of their Q1 guidance, the guidance for the April to June quarter. So for Q4, the company has reported the 5th consecutive quarter for revenue decline. Constant currency revenue has fallen by 0.3% on a quarter-on-quarter basis, in line with expectations, though there is a positive surprise on the margins. EBIT margins for the company have expanded by 40 basis points to 16.4%. That said, the Q1 guidance is disappointing, minus 1.5 to plus 0.5%. Q1 will be the first quarter under the new CEO, Srinivas Pallia, and he has said his immediate priority is to accelerate growth, and he has come out with a 5-point agenda to revive momentum in the company.
Okay, all right, Rima, thanks a lot for that. Well, I'm looking at the cement names, Ultratech Cement as well as India Cement. And the reason I'm looking at Ultratech is for two reasons. But let's get to the common factor first. Ultratech Cement, they're going to be buying a grinding unit from India Cement. That's 1.1 million ton grinding unit. It'll be backed up by captive railway siding as well, which is always a good thing. And the total consideration they're paying is around 315 crores odd. Remember, it's only a grinding unit, so they're paid close to around $34 per ton, which is more or less in line with how much you pay for a grinding unit. How much did it contribute to India Cements? Well, it contributed a little less than 5% of the total revenues. But why did India Cement sell this? There are two factors that play out. One is the sourcing of clinker for Ultratech Cement will be more favorable in comparison to India Cement. You require clinker to run a grinding unit. So that's why that could be one strategic decision. And the other factor is India Cement is sitting on a debt of close to around 2,700 crores. So it will help them in terms of easing off some part of that debt as well. The second news point is Ultratech is saying they're going to go ahead and they're going to add grinding capacity. And the total grinding capacity they're talking about is close to around 3 million tons. So 1.2 million tons will be added on to this 1.1 million tons unit that they bought from India Cements. And besides that, they're looking at around 1.8 million tons additional as well. The total capex they'll be spending is around 504 crores odd. So you just put the numbers in, they're spending close to around $20 per ton for this grinding facility of around 3 million tons approximately. It'll be viewed positively for Ultratech Cement because they're headed towards the 200 million tons that they've been talking about. And for India Cement, it's freeing up some cash. So that's why good for them as well. Expecting green on both those stocks.
Okay, expecting green on Ultratech and India Cements. Let's hop across to Ekta now. She's going to talk about Lupin this morning. Ekta, hi, good morning.
Well, I'm going to throw in Zydus as well because both of these companies have announced the launch of the 25 mg strength of a particular drug called the generic version of Mybetriq. It is a drug which is used for an overactive bladder, and Lupin in their press release has indicated that the 25 mg strength sales in the US is around $1 billion. Now, Elara has written on it, they say Lupin and Zydus launch is likely to be a part of a settlement. We could see more competition come in. We could probably see Aurobindo launch the 50 mg strength on a future date as well. They've built in $33 million to around $38 million of revenue from this drug for Lupin, Zydus and Aurobindo in FY25. So I expect Lupin and Zydus to be in the green. Let's see how big the gains would be considering that there's already competition coming in.
All right, Ekta, thanks very much for that. Well, Persistent Systems is the next one that we're focusing on. Rima's here with details. Rima, morning.
Hi, good morning. So Persistent has reported another good quarter. The company's top line has grown by 3.4% quarter on quarter. They've ended FY24 with a top-line growth of about 14.5%, and this compares with a low single-digit growth for Infy and TCS and a negative growth for Wipro. But that said, Persistent has been amongst the fastest growing, IT companies, and they've navigated this volatility well. EBIT margins, though on versus expectations of an expansion, have remained flat at 14.5%. Deal wins are fairly healthy, above $400 million. Attrition continues to moderate, and this is one company where the headcount is still going up because most peers are bringing down, cutting back on their headcount. But for Persistent this quarter, about 500 million increase in their net employee headcount. Back to you.
Okay, thanks a lot for that. Well, Vamakshi is joining in to talk about HDFC AMC and why you should be watching that one. Vamakshi, over to you.
Well, the stock is in focus on the back of its numbers. A mixed set from HDFC AMC. Revenue was a slight miss, but the bottom line was higher than what the street was expecting on account of higher other income as well as lower taxes. Now, when we look at the quarterly average AUM, that has seen an uptick of almost 11% sequentially. The market share has also improved marginally to 11.3%, but the revenue yield that has come off a bit, down almost 3 basis points sequentially, and this was mainly on account of a one-off impact due to fall in TER of some of the schemes. The net profit saw an uptick of 10% sequentially, and this was higher than what the street was expecting, and that was mainly, like I pointed out earlier, was aided by the other income as well as lower taxes. Now, we have a couple of brokerage notes that came in on HDFC AMC. Axis Cap has retained a buy rating, but they have gone ahead and raised the target price from 4,300 to 4,425 rupees per share. They believe that on a sustainable basis, the yields are expected to moderate, but the AUM growth will drive the earnings for this counter, and in fact, they've gone ahead and increased their FY25 as well as 26 EPS estimates by around 3% on the back of better AUM growth. Other than that, lastly, Prabhudas Leeladhar has also retained a buy rating. They've also gone ahead and increased the target price from 3,900 to 4,100 rupees per share.
Okay, all right, Vamakshi, thanks for that. Well, let's go back to Abhishek. He's here to tell us about IRDA's numbers. Abhishek?
A strong AUM growth, but that's not translated into meaningfully PNL growth. AUM growth is at 26.8% YOY and about 18% sequentially. Asset quality in terms of gross NPA ratio has improved sharply to 2.36% versus 2.9% in the previous quarter. Net interest margin is up on a YOY basis. The NII growth is at 35.3% YOY and 7.5% sequentially. Provisions are down massively by 81% YOY and 75% sequentially, which has helped the PAT to improve marginally by 0.4% on a sequential basis. Back to you.
Okay, Abhishek, thanks very much for that. GSPL should be in focus, I think, on the downside as well. Sonal is here with details. Sonal.
Well, yes, there is some negative news which is coming in because the PNGRB has gone ahead and cut tariffs for one of its main pipeline in Gujarat, which is the HP pipeline. And the cut is massive. It has been cut by 47% to 18.1 rupees per MMBTU. In fact, GSPL had asked for a tariff around 50 rupees per MMBTU. But there have been changes in macro since then as well in terms of gas prices. And the PNGRB has also taken into consideration different volumes. So that's why the cut has come by. Street expected a cut of around 10 to 15% basis the changes in macros that we've seen, and management said that it is studying the order right now. And remember, the EPS cut that will be because of this tariff cut will be around 30 to 40% in FY25, and that's why I expect a red on the stock. Also, Gujarat Gas will be in focus because GSPL holds 54.2% stake in the company. Right, Sonal, thanks a lot for that. So negative news there, but also negative news for Ramkrishna Forgings. If you remember, a couple of days ago, they had announced a big order from the largest passenger vehicle EV manufacturer in the US. So the stock had rallied quite a bit. Now, a couple of days ago, they put out a release saying that that order has been put on hold. Now, we do understand from company sources that the order was from Tesla, and the order from Tesla has been put on hold. There's no reason cited for, why this order has been put on hold. So more clarity awaited from the management. But the earlier discussion that we had with Ramkrishna Forgings indicated that the order was for 8 years, and they are looking very keenly at opportunities in the electric vehicle space, not just in the US, but in Europe as well. They were sticking to their margin guidance of 23%, their volume growth guidance of 15 to 20%. But now, post this order, do they change that guidance anyway? Or we'll have to find out from the management. A lot of analysts that I spoke to are saying that because, Tesla is undergoing a bit of an issue where they're cutting costs, they're laying off their global workforce, sales have fallen. That could be one of the reasons why they have put this order on hold, but there's no official confirmation on that. But I'm expecting the stock to open in the red today because of this order put on hold. But he has a, yeah.
Okay, all right, Sonia, thanks for that. Well, here's a quick recap of all the top stocks that we just discussed for you. The ones with positive news flow include HDFC Bank, Ultratech Cement, India Cement, Lupin, Persistent Systems, HDFC AMC, and IRDA. While stocks with negative news flow include Wipro, GSPL, as well as Ramkrishna Fortunes. Those are about all the stocks that we'll be tracking. But as always, let's get in Manisha Gupta. She's joining to tell us what's going on in the commodity space. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we have seen some more decline coming in, and this is after 3.5% of a cut in the previous week as well. Well, the Iran and Israel tensions kind of de-escalating have taken the premium off the prices, and then the expectation that the U.S. Fed will not cut rates until the month of September seems to be weighing on as well. The markets also are looking at the latest U.S. oil production data, which is at record highs, and the U.S. inventory is also gained up by 2.7 million barrels. That is weighing onto the markets as well. But it's not just energy. The precious metal prices also have finally come under some profit taking after that one-way rally and string of record highs that the gold prices were trading at. There is a while support from geopolitical tensions, but the prices have seen decline due to one, profit taking, and then Fed rate cut expectations now to the second half of this year. There also is the strength in US dollar and yields that seems to be weighing onto the markets. So while gold is trading well below 2,400, silver has seen a percentage point of decline as well.
Right, Manisha, thanks very much for that. So that's commodities and precious commodities in focus. We'll take a quick commercial break here. Prakash Devan will be here. We talk specific stocks, HDFC Bank, Wipro, and many others with him. We also have an exclusive chat lined up with Wipro's top management where they discuss the company's fourth quarter performance. Stay tuned for that as well.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. For starters, the Gift Nifty is suggesting that we open up gap up with a gain of closer under 140 points odd. But plenty of stocks to discuss. Prakash Devan joins us to help us out with some fundamental analysis. Hi, Prakash. Good morning and good to see you, Ben. Prakash, what do you make of HDFC's bank's numbers? There are a couple of positives in there. But the street went into that weekend, expecting a bit of a positive surprise because the stock ended virtually at the high point of the day. At around 1,530, would you be a buyer? Would you be looking to add the stock?
Good morning, Nigel. So, the numbers definitely had a few surprises, but I'm not too sure whether they were positive or negative. In fact, quite a few of those things were out of the box in terms of expectations. Especially, the employee benefit amount that they've allocated, the floating provision that they have done, which of course is not very significant. It's less than 0.5% of the entire loan book. But, the street is wanting something very decisive to come through from these numbers. And my personal sense is that it's a bit too early for that to happen. But these numbers definitely tell you that the merger between the bank and HDFC Limited has started showing signs of being digested and normalizing, right? And that's exactly why you see certain improvement in, let's say, on the growth side on the retail loans. They've probably stayed back from expanding the corporate loan book for various reasons. They've not improved, rates that they give out on deposits, which is a conscious strategic decision. But the ratios are seeming to start falling in place. So if you ask me at 1560, what do you do? You can buy HDFC Bank on dips. You can buy HDFC Bank when you have the money. There's no need to go and rush into buying it today for the simple reason that the change is still going to take some time. But definitely what it tells you is that the management knows what it's doing. There are certain improvements that they've been able to clock. And there will be certain disappointments which are still part of the legacy from the merger. So I would believe it's a mixed bag of sorts. But yes, things definitely look like they've started moving. The wheels have started turning, as you would say, but a bit a tad slower than what the street would expect. I would wait for buying into it, given the time correction or consolidation that it would still go.
Okay. What about persistent systems, Prakash? The numbers looked quite good actually, and in a situation where its larger peers are lagging so much, this is a very healthy growth that Persistent has seen. If you own the stock, would you sort of build on to your gains?
Good morning, Sonia. Oh, absolutely. See, the mid-cap IT is demonstrating a fair degree of agility and nimbleness in terms of what they have been able to do even in a stressful environment, right? I mean, new order wins are not something which these companies rely on. They continue to provide value-added services. And their spaces like that, ENRD and generally, these niche areas are where you still have pricing power. You're not kind of competing against a host of other players. In fact, the competition in this space has started to kind of, reduce or normalize in terms of that hyper-competitiveness is no more there. So I would believe it's these smaller, mid-sized companies, not smaller, but mid-sized IT players, which will continue to start showing very good numbers because of the resilience that they have. And all of this P&L goes into making the balance sheet stronger, right? So, I mean, and that's why they keep talking about acquisition. They keep talking about expanding certain areas, with verticals that they are doing well in. Unlike the bigger players where they have to really do much better to actually move the needle. So I would believe if you hold Persistent, be persistent with it. It's doing its job well. It will start kind of outperform. It will continue to outperform the sector as a whole. Whether IT is an outperforming sector vis-a-vis other sectors is a separate question. But within IT, I think these mid-sized names will definitely be much better.
Prakash, morning. Sterling and Wilson, I mean, the price has corrected quite a bit. They came out with earnings, and I think with a quarter, they've turned a pat. For the year, of course, I mean, that number is not ticked positive, but what's your sense here? Of course, the concern has been falling prices out of China, all the exports coming out of China at deeply discounted prices. But would you want to take a bet on this one?
So, good morning, Prashant. So, I think S&W is very clearly under repair. We saw what money, the kind of money that came in to shore up the balance sheet did, because it has been beleaguered for the last many years. Things start to, in these numbers, very clearly there's indication that things have started to look much more favorable, better. But still, a base effect. So remember, you might see numbers which look like 100% improvement in EBITDA or profit and all, but then that's because, the base effect comes into picture. For the kind of business that it needs to expand into or grow to, there's still some headway. So it's not something which is going to be like immediate in a quarter or two. You'll start seeing dramatic changes in the numbers, but the balance sheet is much more healthier. The deleveraging has started helping out, but they'll constantly need to fund themselves. If not, let's say in the next 6 months, at least the next 9-12 months to be able to continue with this improved growth. So there is competition, and as you rightly said, I don't see any change in stance from the Chinese onslaught of low-cost dumping in this space. They will have to struggle. The key trigger could be if Reliance were to start using this platform for some of the other renewable energy verticals. If that happens, then there is a significant visibility of growth and hence improvement in the numbers. So I would not want to buy into it because the big run-up that happened is already been sold into. You'll probably see it getting chipped into by small investors, institutional investors at some point in time as the visibility comes through. But at this point in time, it'll probably be more sideways and then not something which is very great tactical.
Okay, well, I have many more questions for you because there are a slew of numbers coming through later this week, right? You have Axis Bank, Bajaj Finance, HCL Tech. So I'm going to ask you that in a bit. In the meantime, let's talk about Wipro. Its fourth quarter numbers came in along expected lines. The slight slip in constant currency revenues was less than expected, as was the 8% drop in net profits. For the fifth quarter in a row, the company's revenues have contracted. The company has, however, turned in a disappointing growth guidance for the first quarter of minus 1.5% to 0.5%. My colleague Reema caught up with the Wipro management to discuss in detail on their Q4 performance and began by asking the uncertain macro environment and the key priorities that lie ahead. Listen in.
The priority for us at this point in time is how do we execute to the 5 priorities that we called out, right? Whether it's to do with creating a large deal momentum, or whether it's to create a growth in some of our large accounts and also accounts that we think can be large accounts. We make sure we have the right solutions for the clients which are infused with AI but consulting led. And then the last but not the least is building the skills which actually are very industry specific and also can be able, can offer the solutions that we have for the clients. So to me, instead of trying to predict what's going to happen, I think what's important for me and the team and for Wipro is to execute to what's coming in our way.
And is there a possibility that this environment that we're seeing extends into even Q2 and Q3, Srinivas?
So Rima, it's really difficult to predict. If you look at our clients in different industries, it's not that the discretionary spend has completely come out, right? There is a cautious spend on the discretionary budget. And some of the industries, for example, BFSI, where we are very dependent on discretionary spend, we have to be very careful and keep a watch on how the spend is happening. So to me, predicting Q2 and Q3 at this point of time is too early because of the uncertainties in the macro environment, including the war situation that we see in and around in the world.
Srini, you've taken on this top job for the next 5 years. What's been the ask from you, from the Premji family? When he handed over the reins of this company, an insider, you've been with the company, you've known them for the last 30 years. What was the key ask, if you could tell us?
So, Rima, they asked the same questions that you have been asking me so far. When can we get the growth back? Of course, like Aparna said, profitable growth, right? Clearly, it is. But I think what's important, for us at Wipro is how do we get back to growth step by step? I think, we need to be very clear in terms of what are those industries, what are those markets that really we want to go after, and what kind of solutions and skills that we need to build within the organization. So, very clearly, having that priorities and calling out those priorities and also executing with rigor is what the conversation I had with the board as well as with the family, Rima.
Okay, so is there going to be any change in strategy so that you go after the right industries, the right markets, make sure you've got the solution that you want? So is there going to be any change in the operating structure of the company or any change in the strategy?
So if the strategic priorities that we have called out, it will continue to evolve. It depends on the market dynamics and of course the technology evolution, right? So today, GenAI has come in and it's actually disrupting, whether it's in the technology space, whether it's in the business or in the operations. So we will continue to watch that and prioritize where and how we want to invest in the context of the GenAI. So that I think to me will be constant and will continuously evolve. But when it comes to structure, Rima, I was very clear that we are not going to change the structure. We're going to have the 4 SMUs, we're going to have the 4 GBLs, and leadership and people may evolve, but structure we're not touching.
Okay, leadership may evolve. Aparna, why do you see margins range bound in the near term? And again, that's 17% aspirational. You're only 60 basis points away from that.
Yes, Rima, what Srini had shared in his speech as well is that we are going to be range bound in terms of the margins that we have delivered over the last few quarters. If you look at our journey over the last 8 quarters, we've improved our margins. We've been consistently improving it. And the last 4 quarters, particularly given a very challenging revenue environment, we've gone ahead and improved 40 basis points. And that I think is a very, very, it's a good reflection of the operational excellence and the rigor that we are driving. You are indeed right that we are 60 basis points away from 17%. It is a milestone. It is an aspiration that we all have. But one step at a time, like Srini said, revenue is very, very critical and the growth is very, very critical. We will remain very focused in investing for growth and drive operational excellence. And our margins will be a function of these 2 factors.
Saurabh, 6 consecutive quarters when the net headcount of the company has declined. Would you be surprised if again, next quarter there is a headcount decline? And again, on margins, where do you stand? Is it in the comfortable zone now, or do you see margins trending, attrition trending low? I'm sorry.
So on the headcount, Rima, you've seen this playing out given that the demand environment has not been so great. Over the last few quarters, we have not grown. This fiscal, we have degrown as a company. We had room for operational efficiency, which we have used. Our utilization in this quarter has reached a all-time high for us. So we are very happy that we have made operational improvements, and because of the demand environment has led to from a headcount perspective. I believe that we will continue to work on operational efficiencies, but as the demand environment improves, we will see headcount growing back. From an attrition perspective, I'm seeing that what we were seeing a declining trend over the last few quarters, it's plateauing now.
Okay, that is the word coming in from Wipro, and the guidance is pretty muted there. So let's see how the street reacts to that. But our market is all set to open well in the green. 150 points is what the GIFT Nifty is suggesting. Anuj joins in for a quick trade setup. Anuj, lots of things working in our favor today, but you tell us, how is trade looking for you?
Morning, Sonia. Indeed. And you know what? The indications were there on Friday, right? When it looked like perhaps it was a good buying opportunity. What Friday has done, it's given some kind of a hard bottom for the market. It marks a hard bottom for the market. What's hard bottom? When the markets bottom out with bad news. That's what the Nifty did. So Friday's low of 21,777 should now hold and hold for some time. And even this Iran-Israel conflict, I think, will now incrementally stop impacting the market much. The diminishing marginal utility concept will apply here. Brent crude prices also down significantly. That's also something which would go in our favor. Also, I think there's a likelihood of a pair trade playing out. Some more traditional plays being preferred over some of the recent plays. Elon Musk, for example, tweeted and confirmed that he's not coming to India for now. Friday, we saw a big decline in names like Nvidia, Tesla. Nasdaq was down 220 points. There's clear signs of a slowdown in EV sales and Tesla cutting prices. Brent crude is down. So my sense is, you could see stocks like, for example, Maruti, etc. do well, and comparatively stocks like Tata Motors, etc. could start to underperform. All the stocks that ran up because of the Tesla factor could see big fall today. Stocks like RK Forgings, for example, oil marketing companies, paint stocks, Interglobe Aviation. I think these are stocks which could see a bit of a rally today. The other point, of course, is HDFC Bank. Let's see how the stock opens, because the verdict from the street is actually a bit of a thumbs up. Most brokerages are giving a positive view, especially focusing on the NIM expansion and balance sheet repair. But let's see, the stocks rallied a bit already. It may have made some kind of a bottom, but for rally to happen, I think we'll need some more evidence and maybe the MSCI inclusion. Now, in terms of Nifty outlook, the first resistance will be 22,284 to 22,310, the 10 and 20-day moving average, where we'll open most likely. And bigger resistance is 22,450 to 22,550, the option zone. Support comes in at 22,147, Friday's close, and bigger support is 22,120, which is the 50-day exponential moving average. Not giving a strategy on Bank Nifty today because I think I want to see how HDFC Bank moves today. And finally, the quote of the day. It's Monday, so it's related to that. We talk about Monday blues, but Monday is actually time to motivate yourself and chase your dreams. That's the quote that I have for you for today.
Okay, Monday motivation, right? Thanks a lot, Anuj.
And let's go. Let's do it.
God knows we needed that today, really, at the start of the day. Okay, thanks a lot for joining in. Let's take a quick break. On the other side of the break, Mitesh Thakkar, Sudarshan Sukhani will join in for a technical check of the market.
Okay, welcome back. We got the market, which is going to kick off, the pre-open at least, will kick off in about 12 minutes or so. It's going to be a good start. I mean, it's come off a little bit. At 8 o'clock, we looked at the GIFT Nifty was implying a 150-point higher start, 120 now. But as we've been saying, there's a bit of a sigh of relief. Weekend has been quiet. That's good news. Mitesh is with us, and so is Sudarshan to run us through the trade setup and specifically what you need to do with individual ideas, etc. Gentlemen, good morning. Good to have both of you here. Mitesh, we got to the 21,700 low. We were watching 21,800. And then we got a very large bounce on Friday. Again, I think last hour on Friday we were talking, asking you whether it's done. I mean, we've kind of finished this leg down and it's going to be a gradual kind of zigzag move up. What's your sense now, looking at the US market action as well?
Morning, Prashant. So I think, we got a low of 21,777 and then bounced back from there, which is close to 21,800. That was respected and the bounce back was much stronger. When I was looking at the charts over the weekend, you could see that the hourly indicators have been pulled on the upside. So my belief is that we've marked a low, but I'm not sure, whether we'll have an uptrend immediately. What could happen is that low would now act as a very, very strong support area, and therefore it could be a slightly bigger consolidation. But on the upside, the level which I'm watching is around 22,450. I think once we see a move beyond that Monday gap which happened last week, once that is filled, then I think we'll be in a much smoother kind of a ride on the upside. Till then, I think it will be a market which might still be doing some consolidation. So while we may not break below the earlier low or the low which we made on Friday, but the idea is that the signs of reversals are not fully there. So I think time to wait and watch. But yes, you can always take short-term trades.
Okay, all right, got that. Mitesh, Darshan, what about you?
Yeah, good morning. See, there are two undercurrents now. One is what is the market view for today, and that is that the rally that we saw on Friday is probably likely to persist and continue. There may be intraday dips, consolidation, but the trade for the short-term trader who's taking a trade for the next couple of days is to buy on every dip, and for the Nifty and the Bank Nifty both, the Bank Nifty likely to outperform. But there is a buying opportunity in both the indices, but this is not a sign that the downtrend that we saw recently is coming to an end. Far from it. I am always suspect of V-shaped recoveries. They never last. The markets have to stay at one point, consolidate, build a base, and that becomes a starting point for a new rally. So while next 2 days could be enjoyable for an uptrend, don't think that we are beginning towards new highs again. This is going to be a painful process. So for the next, say, few weeks, we have to be very careful. For the next 2 days, buy on dips.
Okay, be very careful for the next few weeks, but for the next 2 days, buy on dips. So what would your stock-specific ideas look like? Sudarshan, you go first.
Yeah, see, Dr. Lal Pathlabs is an intraday short with a stop above 23.33. But I also have buying ideas. One of the favorites nowadays is Bajaj Auto, stop under 8,700. The second buying idea is Cummins. Both of them are outperformers and both have done well even in this decline. Keep a stop under 29.65. Finally, an intraday short again, Jubilant FoodWorks. It's a very poor chart. Consider going short with a stop above 458.
And Mitesh, what about you?
I have all buy calls, as Sudarshan was saying, next couple of days could be still on the positive side. I think that would be the case. ABB has corrected and given a pullback to its averages, so that could see a good bounce back. So buy here, keep a stop below 61.20, look for targets of around 63.50. Reversal happened on the short-term charts of Bajaj Finance, so that's a buy with a stop at 70.70 for targets of around 72.25. Also a buy on Escorts with a stop at 3075 for targets of 3200, and Bharat Forge is a buy as well. Keep a stop below 1180, look for targets of 1240.
We'll leave it there, gentlemen. Have you back soon again. Thanks very much, Mitesh and Sudarshan, for those ideas. We'll take a break. We are back, a pre-open session with us. We'll also get you a conversation with Arun Misra, CEO of Hindustan Zinc, and they talk about the fourth quarter earnings and their F525 guidance as well. Stay tuned.
Well, let's go across to Chandan Taparia. He's a derivative and technical analyst of Motilal Oswal Financial Services. Chandan, hi, good morning. How are you feeling about the market? It's looking pretty good. Do you think we can build on to our gains? And what are the stocks to look at this morning?
Good morning, Sonia, Prashant and Nigel. Thanks for having me. So we witnessed a decent recovery from the lower levels. If I look at the entire price movement, in the recent corrective move, the Nifty has corrected by more than 1,000 points from 22,775 to 21,777 marks. And now the way it has witnessed a recovery and forming a bullish price pattern indicates some sort of bounce could be there and it can retest the retracement zone. So the retracement 61.8% comes at 22,400. So we are expecting index to head towards 22,400 to 22,500 zone as of now. Looking at the Bank Nifty index, it respected and turn from the lower band of the rising channel, which is working well from last couple of weeks. So with the support of 47,000, we are expecting a recovery towards 48,500 zone in Bank Nifty as well. So both the indices have seen the recovery and support from the lower band of the channel. So some sort of recovery could be there in indices. Now looking at the stock wise, first it is buy on HL, one of the strongest trading stock. Technically, it formed a bullish pole and flag pattern, which is the positive stance. So expecting fresh leg of rally in this defense counter, one can buy with support of 36.60. And here we have a target to us 39.20 level. Second trading idea, there is buy on trend. It has given a consolidation breakout of last 9 weeks. It has given a decisive close above 4100 zone. And we have seen built up of long position, which also indicate fresh leg of rally. So such kind of price setup clearly indicates 5 to 8% run up in the counter. So one can buy with support of 4070 and stock has potential to rally to us 43.25 level. Last trading idea, that is buy on M&M from the auto peg. We have seen some recovery in the Nifty auto and counter like M&M, Eicher Motor, Escorts are showing the sign of strength. So here we are recommending to buy on M&M. The stock has given a consolidation breakout after the corrective move of last 4-5 trading session. And as per the price pattern, it is all set to start the next leg of rally. So recommending to buy on Mahindra and Mahindra with a stop loss of 2040. And this run up can head to us 2160 levels.
Okay, thanks a lot for that, Chandan. Appreciate your time here. Well, let's get back to Prakash Diwan, who's still with us. Before some pre-opening rates kick in, just wanted to get some news out of him. Prakash, I wanted your thoughts on some of these real estate companies. Oberoi Realty is in focus. The booking value in Q4 looks pretty good, actually. Almost 1,800 crores of booking is what they've seen compared to 800 crores last quarter. I know it's pretty lumpy in nature generally, but this entire pack has been doing well. Do you still like any of these real estate stocks?
So I think, Surya, that's definitely going to be a very interesting space. And given the kind of traction that you're seeing in terms of buying, it will continue to do well. But Oberoi actually has mentioned that for the full year they've had a little bit of a cut reduction in bookings as compared to the previous year, which means some of these companies would see sales peaking out in the next 6 months. But there's one name that's probably not yet participated in that same way, and that's Century. My sense is Century also has a very strong inventory, and then if you want to add up to it, the India Bulls real estate piece will start kind of chiming some sort of news flow around launches, around monetization of some of the assets, because they're sitting on a huge land bank. They're just waiting for some of the NCLT procedure to kind of get done with. But very clearly, this is going to have this space where you'll have to find names which are yet to kind of start monetizing their assets and inventory. The ones like DLF and all, which have already done in the past, have already been rewarded in terms of the stock price. But there are lots of names which are joining the cycle much later. And then you can, of course, play it with all the other input side in terms of construction material, whether it's pipes and cables and wires or tiles, because that space is far more resilient, irrespective of which player does well. So I would look at it as a combination, some of the strong RE names, and of course, some of the construction material plays. So that's a combination that probably will be better off.
Okay, all right. Prakash, very quickly, Tata Motors was one of the big losers last week, down close around 5%. Mr. Musk is not coming so soon. So do you think that one of the reasons that the stock was under pressure was because of the potential entry of Tesla, or do you think the price points are very different? And any kind of weakness, would you look to buy into the stock?
So, Nigel, I think Tata Motors, the peak in this move that you've seen in the last 1 year plus is going to be the announcement of the numbers. The deleveraging of the balance sheet will probably trigger the best level of interest. And probably that's where the stock will start consolidating. So it's more of a balance sheet trigger rather than a business trigger at this point in time. I think they'll continue to do well in the price points that they are. India is a very price sensitive market. Probably the Teslas of the world will be able to sell only to a very small sliver of consumers. But Tata Motors, with its distribution reach, with the kind of acceptance of its vehicles, will continue to do well. I don't see any reason, but their good profit booking is part and parcel of the kind of move that we've seen. But I would believe the deleveraging announcement will probably get the stock more exciting.
Okay, all right. Prakash, always good hearing your thoughts. Thanks a lot for joining in. Wishing you a good Monday and a good week ahead as well. But let's get to some earnings then. Hindustan Zinc, well, it's been a big move in the last 1 month or so because of the exposure that it has to silver. But they came out with their set of numbers. It was pretty much in line with what the street was working with. Mr. Arun Mishra, the CEO of Hindustan Zinc, joins us on the show. Hi, Mr. Mishra. Good morning and good to see you, Win. Well, you've been a little bit cautious in the guidance. I say that because in the past you've spoken about silver production moving towards 800 tons. You've also spoken about cost of production coming down to around $1,000 per ton. In that backdrop, it appears a little bit conservative. Tell us more.
Both are in that direction only. We are still trying for $1,000 cost, and in the guidance we have given about 1,050 to 1,100. We should be closer to $1,050 per ton, and I'm quite hopeful of that. At the same time, must have noticed that we are trying to produce more than 1.1 million ton of metal next year compared to just 1 million ton, 1,033,000 tons of metal this year. When we are trying to produce that much more metal, it will come out of more zinc, less lead, and hence less silver as well. If, in spite of all that, we are trying to produce about 745 tons of silver next year, which is compensating for another loss of silver because of more zinc. At the same time, we are using fumer to add another 30 tons to it. So overall, 745, 750 tons of silver is absolutely possible next year with 1.1 million ton of metal. However, we are very dynamic on this. If the prices of zinc does not move faster, while silver run away, then we may refocus, maybe produce a little less on metal side, on the zinc side, produce more lead and hence produce more silver and go up to 800 tons.
Okay, so on zinc, what is the price band and how is the global supply demand of zinc now?
No, so there are two. One factor is we are looking at price of around, we were hoping for a $3,000 per ton price in the month of December. But looking at the current sharpness in increase in prices, we believe that that mark will be breached much before December. Somewhere maybe August or September, we should get a price beyond $3,000 per ton. Globally, the situations are improving everywhere. At the same time, LME restriction on stocking in Russia because of the sanctions and all that will have lesser opportunity for various players to come into the zinc market. And we believe that that will keep on pushing up the price of zinc globally as well as in India, of course.
All right, got that. Mr. Mishra, what is the silver price outlook from here on?
Silver is currently about $28, $29 per troy ounce. It will cross $31, $32 per troy ounce because the globally, so we are now third largest in the silver producing company in the world. We moved up from 5 to 3, not so much by our increase, because of decrease in production of the many companies across the globe. Okay, so there is a short supply. At the same time, the demand of silver is increasing primarily because of higher industrial use of silver, because of the focus on renewable energy, the solar panels, focus on mobile telephony, the number of mobile sets increasing year after year. So all that will continue, and the power grid, power transmission lines, hence the power substations, hence the protection fuses, which of course use a lot of silver in the contacts. So keeping all that in mind, industrial use will continue to grow, whereas there is a recurring short supply of silver. So prices are bound to go northwards, and I see anywhere between $31, $32 per troy ounce is easily doable in the near future.
All right, Mr. Mishra, could you give us a sense about the coal sourcing situation? You'll have adapted such that you can use more amount of domestic coal. So how is it right now?
So we have been benefited by a huge supply from Coal India in the last quarter. About 40% more, 44% domestic coal we could consume, and fortunately we had also modified our powerhouses to consume high amount of domestic coal. Some couple of power plants in Chanderiya could go up to about 75-80% domestic coal as well. So that has helped us to cut costs, and coal situation in India is very, very favorable to us. We will continue to get more domestic coal in India. We are participating all linkage auctions as whatever is available to us, and we are blocking supply as well. So I don't see any threat as far as coal prices are concerned or availability of coal is concerned.
That's good to hear then. But let's get to a couple of spicy details then, Mr. Mishra. Any fresh proposal for Hindustan Zinc to go ahead and buy Vedanta zinc assets?
No, I'm not looking at that anymore because we are on the drawing board to double the capacity of Hindustan Zinc in India itself. We are currently producing about 1 million ton metal. We are working with various consultants to double the capacity of output from mines, at the same time double the capacity of output from smelters. We are on the conceptual design development phase. Another 2 months, by July, our design should be over. And if the reports are favorable, we'll take it to board. Maybe August, September, sometime we can come to market and announce what is our next phase of growth. But I am surely looking at something way beyond 1.5 million ton, what we had predicted earlier.
So what's the update on the demerger of various businesses?
No, that is still there, and we are working with government, and they had certain objections to it, which we are. See, basic apprehension was government was doing the OFS, and it was perceived that the restructuring at this point of time will be conflicting with the effort of OFS being done by the government. Now that the share prices are high, we believe that this is the right time to do the OFS for Government of India. And if that OFS can be, done away with in 3 to 6 months' time, of course, it will be followed by restructuring of the company. Even if both happens parallel, we see no problem in it. And currently, our valuation in the market is about $20 billion plus. And we are looking at, if we do the separation of silver and lead zinc company, another $3 to $4 billion can be added to the market cap.
All right, Mr. Mishra, final question then. Valuation-wise, Hindustan Zinc is not cheap. In fact, valuation-wise, is looking expensive at these levels. But what's your view if the government has to go ahead and do an OFS? What could the potential OFS price be?
How do you do it then? When the prices are low, you wouldn't do OFS, then people would say, government has lost money because they have sold out at the low price. When the prices are high, also you will not sell because people can't afford. It's like the situation, So I remember from my childhood, gold was always precious. Every time it was unaffordable. But still people buy gold, right? The good shares are also like that. They will remain unaffordable all the time. But there are enough number of people in India who can buy. I'm sure one has to come to the market and start selling. Once people see the intent and the determination, I'm sure then the investors are faith in the disinvestment process, and then they start investing.
All right. Well, thanks a lot, sir, for that. Appreciate your time here on CNBC TV18. But the other big news flow that we're dealing with this morning is PNGRB has cut tariffs by 47% for GSPL's key HP pipeline network. So GSPL, of course, could be under pressure today. But to discuss what led to this sharp cut in tariffs, we have A.K. Tiwari, the member of PNGRB, with us. Mr. Tiwari, thank you so much for joining us. If you can just explain the rationale behind the sharp tariff cut.
Good morning. Good morning to Prashant, Sonia and Nigel. And actually, the combination of few things are for the determination of the tariff. We have recently concluded the capacity of GSPL and all other entities done by the Engineers India Limited, CapEx, OpEx, which has some adjustment. And one more important thing is the 12% post-tax IRR. So the volume which was done earlier, now they have, GSPL has got better tariff earlier, so that has been adjusted. And one more thing is important, that future their plan for the spur lines, for the Swan terminal connectivity, Chara terminal connectivities, all these have taken together. And the main thing is the volume. So based on the normative volume and actual volume which has flown, the tariff has been adjusted. So we have given the 12% post-tax IRR, that is there. That is as per the regulation. So there is no cut per se in the tariff. It is only adjustment.
Okay, you're saying it's only adjustment, but are you open to any kind of discussions on this? And was a proposal made or shown to GSPL before the final order was taken?
Yeah, we have done the consultation. We had all the PCD public consultation. We have taken all the information. Everything was done, and then the tariff order was issued. So there is nothing. And 94 pages of the tariff order which are there, it gives the total glimpse. So there is nothing which was not known to the GSPL or GSPC that way. So that way, I think the tariff has been determined that way.
Mr. Tiwari, hi, good morning. Prashant here. LNG prices are expected to be, there is expected to be a glut for global LNG globally. later this year and into 25 as well. So just a quick point. Should we expect something similar in the case of GAIL as well? Gas Authority, the next tariff revision there is due in June.
Yeah, there will be some. I can't commit at this present because the tariff already has been concluded of the GAIL. But I want to say that we have already determined the capacity from done by the Engineers India Limited, including the GAIL and various other pipelines. So that way, we will see the tariff whatever it could be, and means per se transaction has no relation with these things because the pipeline which are there, 12% post-tax IRR which are there. One thing, Prashant, I would like to share here, one important thing. The government of India and the PSGRB has been able to create ecosystem, including the gas-based economy for national gas grid, north, south, east, west, and in between. We have already authorized the CGD for the entire nation, LNG terminals connectivity with the pipeline, and the ecosystem which has to be created. So all these things have been done, and reforms of the regulatory reforms, fiscal reforms, and the tariff reforms which are there. I am very hopeful that these companies, be it GAIL, be it GSPL, are going to perform good, and they are going to have better consumption. Yeah.
No, absolutely. And good of you to highlight some of that. Mr. Tiwari, sorry, just to press on that point without getting any specific numbers out if you're not looking for that, but you're saying that the tariff order has been, for GAIL is kind of there and it'll be out in June and there will be a revision lower, right? Without going into specifics.
I can't say at present. No, I can't say it. I can't commit that way, whether it could be lower or higher. But 12% post-tax IRR is the benchmark of the in the regulation. So that is there.
All right. Good morning, Mr. Tiwari, and good to see you. And, the question that the street will be wondering about is whether or not GSPL will come ahead and appeal against the order. The shareholders would definitely like that because as of now, the stock is struggling. So is there a possibility for you all to come to some meeting ground? Will they appeal?
We have given the detailed order, and I think if there is anything is there, they can come up. It is not an issue. It is already always if there is any something is there which can be seen. I think that is always in the tariff order. We have also given one thing in the last. If you see volume adjustment, which they have projected 26 MMSCMD. With the kind of progress, vision which you have, I think that will always be up. Their volume will always be 31 plus. So that will be taken into tariff. So we have already, please.
Yes. So, Mr. Tiwari, we got that point then. If they want to come and appeal, you're ready to entertain them. So we'll have to see how that works. But the point you're making about the volumes, they were talking about 26 MMS CMD. While you're factoring in 31, what if the volumes are not as much as you all are factoring in? Then is there scope for some renegotiation in the coming year?
There is no question of any negotiation. If you see the performance of GSPL from the last 10 years, their volume has already been up, 31 MMSCMD plus. And last year volume was 34 plus. So as per the regulation, we take the actual volume of the past years as well as the last year. So that way we have given, but they have projected that there will be some customers base, some customers will not take the volume. So they have projected 26 MMSCMD up to 2031, which we believe that may not be correct. So that way we have taken.
All right. Mr. Tiwari, we'll thank you on that note. Thanks for joining in. We have a market opening as well in just about a minute from now. Looks like it's going to be a solid opening. By the way, let's take a look at HDFC Bank because everyone's eyes are going to be on that stock. Given the kind of results it has delivered, the earnings were in line with expectations. Margins saw a slight improvement quarter on quarter. But let's see how the stock is doing, up almost about 2% odd. Wipro is the other one in focus because of the muted guidance that the company delivered this time. So Wipro, in any case, has been underperforming for a while and that could continue. In the same space, Persistent Systems is a stock that is looking pretty good because the numbers have been good this time. FY24 full-year revenue growth of almost 15%, so Persistent Systems. And then you have a whole host of other stocks in focus. focus. GSPL, of course, a negative news flow that you just heard about is something that could keep the stock under pressure as well. But largely, you'd have to say promises to be a strong opening, and then we'll take it from there.
Absolutely, and I think we'll see if we can climb over some of these resistances, because you're opening right into some of it, right? The 50% retracement, some of the moving averages, all of that coincide there. So we got a 120-point higher start is on the Nifty. And you've got the sensex, which is at about 73,004 something. So those are first rates which are coming through, 22,267. So it's a 0.5% higher start. The Nifty Bank is stronger, 0.75% higher, and 47,915. We'll pull up HDFC Bank in a bit. But mid-cap index is up 0.93. That's a 1% pop. And I think the small cap index should also be opening up in the green. That'll come up on your screen as well. So it's a green-looking screen at the word go at 9:15 this morning. Sonia has got more rates. Sonia.
All right, thanks a lot for that. So let's kick it off with HDFC Bank, because everyone wants to see the kind of reaction on that stock, right, post the numbers. Coming up on your screen, down almost about 0.5%. Earnings were largely in line with expectations, so nothing too dramatic happening on the stock either. Goldman Sachs, by the way, has raised their target price on HDFC Bank to 1940. They had a target price of 1900 earlier. So there are brokerages that are still quite bullish on this stock. Let's move on to Wipro, where the guidance was muted, but the stock is up almost about 2%. So keep that on your radar. Ultratech Cement is buying a 1.1 million grinding unit from India Cement. That stock has been on a tear, so up almost about 1.5% over there. Persistent Systems, good quality numbers coming in. FY24 dollar revenue growth of 14.5%. The stock is coming in for some profit taking this morning, so keep an eye out there. Oberoi Realty, good booking values this time at almost 1,800 crores versus 800 crores last quarter. So big quarter-on-quarter jump, and the street likes that. Ramkrishna Forgings, the order has been put on hold. Sources tell us that the order had come in from Tesla, but that is now on hold. No reason for why the order is on hold. So the stock is reacting negatively, down almost about 6.5%. IRDA is the other one I'm looking at this morning, 9% higher, very strong volume growth. AUM growth of almost 27%, and the asset quality has also improved. So IRDA is looking pretty good. GSPL, negative news flow. Look at that, 20% knockdown on GSPL this morning, as PNGRB has cut tariffs in its HP pipeline. So GSPL is seeing a huge cut this morning. And JSW Energy, I'm looking at that one. JSW Neo has gotten an order to set up a 700 megawatt solar power project from NTPC. So that stock is up almost about 2.5%. So I must say, very dramatic reactions to individual stocks, and overall good performance for the market. Nigel, over to you.
That's right, Sonia. The Nifty is holding above that 20 DMA, so that's pretty good news. From the high of the day, though, it's come off close on 60 points from the first tick of the day. That's par for the course. Stocks that are reacting to numbers. You have Bansali Engineering. Well, that came out with a rather good set of numbers after a couple of quarters, I think. So that stock, in fact, is up close to around 3.5%. One of the top volume traded stocks. IRDA as well looking quite good. So that stock is up more than 10% as you speak. There's limited float on that one, so that stock moves up as well. GMR Power, I think there was a large trade that Nimesh was highlighting to us about. So that one, post that large trade, the stock has opened up with a gain of close to around 5%. I think it's in that 5% band, so it's up close to 5% as we speak. GSPL, as Sonia mentioned, it's down close to around 20%. A couple of stocks are reacting to technical news flow. Case in point being Hindustan Copper as well as Nalco. Both of them have come out of the F&O ban. Everyone's waiting by for this super metal cycle. So that's the other tailwind that they have. So both those two stocks are higher because of a technical factor. They've come out of the F&O ban after a few trading sessions. So both those two moving higher and moving higher on large volumes. HPCL as well as BPCL. Remember, on Friday's trading session, they were a little bit nervous. What if geopolitical issues blow up? And that's what could make crude oil prices move up. And for the next couple of months, we're unlikely to have any kind of a price increase because of elections here. Now, crude oil prices have cooled off actually over the weekend to around $87 per barrel. They were around $91 per barrel on Friday. Explains why some of these OMCs as well are running along. So a good looking screen. The Nifty is holding at around the 20 DMA. You would like it to build on from here on. For the time being, the Nifty Bank as well is participating, holding around 47,900 odd.
Well, some more stocks then. If we can have a few more volume-led gainers right now. We've got Senco, which is starting up higher. And it's such a huge outperformer, Senco. Okay, I think it crossed over into 4 digits. I think it did, then maybe fell a little bit, but 4% higher. Look at the volumes there for this point in the day. Bajaj Electricals is starting up with a 5% pop. Stocks at about, I think, 270. And that'll... okay, I think... Sorry, that's a different name, but this is 950. PTC, I think we mentioned that. is looking good with volumes. Solara is another one which for this point in the day, in the morning, right at the word go, comes up with large volumes. Ujjivan is another one which starts with a 5.5% pop, 580 on that one. Transformers and rectifiers, what else but higher, another 5%. So 6 months, 10x, that one, TRIL, and just a big mover, with decent volumes as well. Premier Explosives has been doing well last week. I think it had a good one, another 7% this morning. So this is, some of the stuff which is coming up with some momentum right now. Exicom on the way down, perhaps. We mentioned GSPL, of course. There's news there. We spoke with PNGRB, but the other one is Exicom, which is up 6.5%. Motherson is another one which is down 4%. So 122, and it's got decent sized volumes. I think we already mentioned RK Forgings, which is down about 5% or so. But that's largely sort of news and sentiment related stuff which is working through the markets right now. 22,260 is where we are at, about 120 points higher right now. Ravi Dharamshi is market master of the day. He's the Chief Investment Officer, Value Quest Investment Advisors. Ravi, good morning. Good to have you with us here. Thanks very much for your time. Prashant this side. Ravi, we are in election season. It's a long election cycle, and all the way into June. I know you're not the one for very near-term kind of outlook, etc. But that's, I guess, top of mind for many. How is the market going to find its way through into the next a couple of months at least? Just any thoughts that you have and how you're thinking about things.
Thank you, Prashant, for that. I think it is really important that you put that in the context that we think from 3 to 5 years perspective, and sometimes not focus on next 2-3 months, something that we do. We probably miss out on a 5% market move because we are always looking 3 years, 5 years out. However, we tend to when in 3 to 5 years outlook.
Okay, I think Ravi, just hold your thought. I think the audio is not very clear. It's dipping and coming up again. So we'll just try and fix that audio, Ravi, and I'll come back to you when I get the green signal. But I'll just wait for that. The market, by the way, is up 130 points and it's looking good. By the way, I think GSPL is down 20%. Is down 20%. Yeah. So limit down.
I just want to point out one stock, Trent, which is at a fresh high this morning. This has been one of the strongest stocks, right? Trent. So it's at 4,220, and that's almost a 40% gain that we've seen in Trent this year, just in 2024. And of course, we all know the story of Zudio, etc., and the way that that brand has performed. But overall, this entire consumption piece has been looking very good, especially some of these names like Trent. The other stock which has hit a fresh 52-week high this morning is Bharti Airtel. So just keep an eye out on that as well. Bharti Airtel too is up almost 25% this year. So big moves coming into many of the telecom names. In fact, 52-week high galore. There's M&M, which is at a fresh 52-week high. Just Dial is at a fresh high as well this morning, and a couple of others. Motilal Oswal sitting at a fresh high. Force Motors, I mean, that stock is up 160% this year. It's really been charging on all fronts. And Thermax is something that is at a fresh high. So there's no dearth of good ideas in the market.
Well, that's right, Sonia. I know a few stocks that are actually moving around. Vodafone Idea, I think today is when the FPO closes, if I'm not mistaken. That stock is down close to around 5% as we speak. It's falling on large volumes as well. So keep an eye out on that one. Some of these cement names as well, little under the weather. You have JK Cement that's down close to around 2.5%. Remember, it's been one of the big outperformers because you're getting volume growth out there, the focus on profitability as well. But for today's trading session, that's a little under pressure. Indus Towers has been a big performer in the last 45 days or so. They're banking on Vodafone Idea surviving and pulling through a next couple of years at least. But that one is coming for some profit taking today. And another one that's on your radar, Samvardhan Motherson. I think, Sonia, you were highlighting that as well. That stock is lower in trade. But Voltas, guys, very hot over the weekend. I was at Vijay Sales as well, because I was shopping over there. But, there was a lot of lines, a lot of, crowd out there. And it's extremely hot.
Although I thought last couple of days it's gotten a little better, no? I mean, the evening.
Is it just me, or is this one of the hottest years we've ever faced?
I think it's the hottest.
We say this every year, but I think this year is really bad.
Because we still have May. Normally it gets very hot in May, but now towards the end of April itself, I mean, not even at the end of April, we still have close to 10 days to go.
And almost 40 degrees every day.
Almost 40 degrees, really hot.
It's hot. And some of the people must also be escaping the heat outside.
To come and cool off for a bit and then leave.
Absolutely. I mean, 100 points right now on the Nifty. The market's losing a bit of ground. We are 120, 130 odd points. We were 120, 130 points higher. Now 100 there on the index. And, Hindustan Copper will come up on your screen. 6% pop. That's a big one. Hindustan Copper is the second biggest volume traded gainer. You flip that and look at the volumes. Humongous for this point in the day. So that's come out of nowhere and suddenly it's occupied the second spot there. With volumes and gains right now.
There's just the technical factor that we pointed out earlier as well, coming out of the F&O ban. So fresh positions getting taken in Hindustan Copper. And coupled with that, there's the stock that we're going to be in this metal bull cycle. So that's why.
Yeah, you need copper, lots of it. Ravi is with us, and I think he'd agree about the importance of copper. He's been a big backer of renewable energy, and we'll talk about that. But Ravi, sorry, we lost you there. Audio problems, but please, if you could start at the beginning. Go on.
Yeah, sure. No, thanks, Prashant. Thanks for putting that in context. See, we tend to think 3 to 5 years out, and we tend to sometimes miss out on the 2-3 months move. But we also would like to, kind of at least identify if there is a large enough move coming on the index or the market. Finally, long term is made up of short term, so we don't want to miss out on that. So clearly, election is the event that is lined up, but I don't think that's an event that is going to give a very large move on either side. Market has been anticipating. The probability is that the event is likely to pan out positively for the market. Even in that scenario, I don't see markets reacting in a major positive way immediately post the election. Yes, it will continue to be a positive, but market has been kind of factoring that in going in. So I don't think that election is a reason for markets to move more than 5-7%.
Okay.
Ravi, since we are on the topic of election, and I know, of course, we'll know when we know, but do you think, 320 to 350 seats for the BJP, I mean, that kind of number is in the price? Only for the BJP?
See, I have no way of knowing what kind of number is factored in, but what I can tell you is, as long as the current dispensation is coming back, even if it is with reduced seats or more seats, it doesn't really matter. All that is good for TV debate. But from market's perspective, what we are looking for is policy continuity, political stability. As long as both those scenarios are not hampered, I don't see any major reaction in the market.
All right, by the way, the market is doing really well. 100 points higher now on the Nifty, holding on firmly above the 22,200 mark. And the best part is the broader market momentum. Just look at that. The mid-cap index is up almost 500 points. And that's a big move this morning. Ravi, hi, welcome to the show. We've been chatting all along, right, in the last many months about how this is a stock picker's market. But now at this point, what are the sectors or stocks or themes that look good to go for the slightly medium term to you?
Yeah, so since post-COVID, actually, we have been focused on more domestic-focused sectors, more rather than export-oriented sectors. And also within domestic-oriented sectors, we were focused more on cyclicals, capital goods, auto, maybe financials. Those were the kind of sectors that were likely to do well. And I think even at this juncture, this particular thematics is likely to continue for some more time. I don't see exports reviving in a big way or rural consumption reviving in a big way yet. But that is the area. The disconnect in the market is what is known is already factored in, and what is not known, the fundamentals are not yet improving.
Hi, Ravi. Good morning and good to see you. And I wanted your view on two sectors. The verdict out there is pretty much split. On chemicals, how are you all placed? You all have a liking for the specialty chemicals companies, which is well known. And also on pharma, that's been the big outperforming sector. We're talking about a lot of other themes that are playing out. Pharma, quietly, it's been moving up. 2024, it's the big outperformer.
So chemicals and pharma both fall in the category of sectors that have not done well for the last 3-4 years. And hence the opportunity has arisen over here. However, what I would like to say is that top-down sector view might not be the correct way to look at it, and more bottom-up stock picking in these sectors is what we should do. See, chemicals had a fantastic run from 2014 to 21, and that was a macro call of China +1, and everything kind of benefited. China put production cuts and India put tariff barriers, so that kind of helped the players over here. But now it is that particular trade is done. Now it is focused on which company has the ability to compete with Chinese or is not competing with Chinese, and which is the real specialty chemicals. Those kind of companies are likely to benefit going forward. So no doubt valuations have become much more reasonable and opportunity exists, but it will still be a bottom of stock picker rather than a sectoral call. Similarly, in the pharma also, as I have always discussed in the past, in pharma also there are various buckets. Oral solid export-oriented generics are unlikely to do well. There is a cyclical uptick over there because the pricing pressure is reducing. But what we do prefer now going forward is stock-specific, company-specific companies that have strength in an area where where the competitive intensity is on the lower side, valuations are a little reasonable, and that's how we are focusing on it. It's not a top-down call on pharma or chemicals, but it's more a bottom-up stock picking in these sectors.
Ravi, could you talk to us about sort of one or two ideas? I mean, just to sort of explain the thesis behind how you're thinking about some of these things, because as you said, I mean, that a bit about China, companies which are perhaps competing well or not facing off against China. I mean, just to sort of make clear the thinking on some of these issues, if you can talk to us through some of these ideas, one or two ideas that you perhaps have liked and are liking right now.
So, sure. So I'll give a sense of the framework that we use in terms of evaluating. Will not be able to speak any particular company specific, but what we do like is a company that is focused on a niche area and has the ability to expand in the adjacencies, not directly competing with the Chinese companies, especially on the mass scale or something. For example, commodity companies where there are no trade barriers are going to be susceptible to very sharp cycle on the upside as well as on the downside. Those are the kind of companies that we would like to avoid. However, there are companies which might look small in their particular scheme of things. Even within chemicals, there are various baskets. So the particular basket that we do like is the pharma intermediates. Because see, India is a large base of API companies and formulation companies. What we lack is the intermediate and key starting raw material, which is where China dominates. So if we can find a company which is kind of a niche in the pharma intermediate space, because the end customer is all in India, and where the market size is not yet so large that the Chinese are supplying to that space. That is the kind of framework that we look at to identify niche plays in chemical or pharma space.
Okay, there's one thing I wanted to discuss with you, Ravi, and that was what's happening with the tech layoffs, right? There are large layoffs happening globally from global tech giants. Even in India, the situation in the tech industry is not that great, with average salaries not increasing for a while, etc. Do you think all of this will impact consumption or demand over the near to medium term? Is that a valid concern?
Yeah, so first I'll give my views on the technology, or rather, I don't consider them as technology companies. They are more technology service provider companies. So essentially, we outsourced IT servicing is what we do. That particular business model has matured. See, we had a great run for the last 25 years. The companies have gone up to create some of the best wealth in this country, and clearly that is feeding into the consumption as well. Because these are all migrant labors that move from maybe the tier 2-3 towns to some of the cities like Bangalore, Pune, and that gives a boost to the consumption, to the real estate over there. It's been a large factor, but going forward, I think their importance in the overall basket of consumption should reduce. And manufacturing as a sector is picking up, capital goods cycle is picking up. Real estate is only doing well at the premium end of the segment right now, not at the bottom. Affordable housing is not doing that well. So to summarize what I'm trying to say is that, yes, at this point of time, IT remains a big contributing factor to the real estate cycle, especially within the consumption also. I'm talking about the real estate. It's a big impact. However, going forward, it will reduce. In fact, if you look at some of the other sectors, the pay increase, the kind of shortage of people on the manufacturing side has been far, far more severe. So that gives you an indication of which way the wind is blowing. manufacturing sector is picking up in India. In the non-IT services part, actually that is doing quite well. So there are other services which are not really IT oriented. They are doing quite well. So hopefully we will be able to replace the demand impact from the IT services by some other sectors, and overall it might not be so much of an impact.
Okay, I have one final question before we let you go, because this is the next discussion. So I just wanted to lead into that, right? Elon Musk has postponed his trip to India. So there are, of course, a lot of problems happening with Tesla globally, with the fall in sales, etc. So the view is that Tesla may push forward their entry into India as well. For a stock like Tata Motors, which has been doing phenomenally well, do you think this could impact them positively, or is that too simplistic an assumption?
I won't be able to comment on a particular company, but what I can say is we all should be looking forward to entry of Tesla into India. I think it will give a boost to an entire new ecosystem that, yes, Tesla already has like 7-8 suppliers from India where they are procuring some or the other parts. But and Tesla overall EV might be slowing down elsewhere, but I think India has a market, the EV is yet to pick up. So it's a sunrise sector, and entry of a giant like Tesla is going to give a boost to a lot of the ecosystem, auto component ecosystem over here. From the perspective of competitive intensity, I think it's in a state of flux. A lot of new EV variant will come to the market. There will be a lot of new launches. And over the next 5-7 years, we can expect the EV passenger vehicle percentage in the markets to go up by maybe somewhere between 10 and 20% in 7-8 years. So that will put pressure on the incumbents and the ICE vehicles for sure. So, but I am not yet willing to say who will be the winners or who will be the losers in that. One thing is for sure, EV as a trend is here to stay, and it will the penetration levels will rise.
Okay, well, that's a very interesting way of looking at it. And that's the common narrative, right? Tesla's entry into India will broaden the ecosystem, will provide jobs, will provide work for a lot of auto ancillary players. So in general, the entire ecosystem will grow. But thanks a lot for that, Ravi. In fact, we have this discussion. We'll carry that forward now. As you know, Elon Musk has postponed his trip to India, citing very heavy Tesla obligations. Remember, Tesla has now laid off over 14,000 employees, which is 10% of their global workforce, including top executives. And they've talked about the reason for this is cost reduction. So with Tesla doing this, what does all of this mean for the Indian EV ecosystem? And are we staring at a two-pronged issue? One, falling sales, and two, a threat from Chinese players like BYD, which is an issue that Tesla is also facing. Jay Kale of Elara Capital is joining in, and in a bit we'll get another player of this ecosystem. Jay, thanks a lot for joining in. You know, Tesla raises, what's happening with Tesla raises a larger issue, that of a global EV slowdown. And we've seen that in some form play out in our own market as well. I mean, EV passenger vehicle penetration is barely 2.5%. Your thoughts on how all of this could, move forward from here?
Yeah, good morning, Sonia. Yes, definitely globally, if you see, the EV penetration has to a certain extent, EV growth has to a certain extent slowed down. But nonetheless, if you see CY23, the global EV penetration, PHEV and BEVs including, is around 15.8%, which had moved up from 13%. So the pace of growth has moderated, but the penetration increases story is still going on in terms of EVs globally. If I have to talk of India, yes, currently, like you mentioned, we are at a very small 2% EV penetration in India. And one main thing is that we don't have as many models for EVs, meaningful models for EVs, barring 2-3 players. And in the next 1 year, we are expecting to see a lot many players entering into the space, be it incremental models from Mahindra, Maruti, Hyundai, all of these players. So as far as India goes, EV penetration is only expected to increase from here. Our assumption is by FY30, we are expecting EV penetration closer to around 15%. So that is definitely much higher than 2% that we are currently at. And that will be led by incremental new model launches. The issues of charging infrastructure, etc., still remain, and that will progressively get sorted.
Okay, so it's interesting. You're saying that the EV penetration is expected to increase from 2.5% currently in the passenger vehicle space to 15% by FY30. And a large reason for lower demand is because there are just not enough models, not enough launches in the EV market in India. Got it. But you know, the question that I was asking Ravi Dharamshi a while back, the fact that Tesla is sort of delaying their visit, Elon Musk delaying his visit, Tesla perhaps pushing forward their plans as well. Do you think that is a positive for players like Tata Motors, or is it too simplistic an assumption?
I think it would be too simple. You know, any which ways Tesla coming into India was not, in a meaningful way in terms of manufacturing was not going to happen in the next 1 or 2 years. Of course, we know the EV policy over the next 3 to 5 years. They would be setting up manufacturing capacities, if at all, in India. Prior to that, there will be more of imports restricted to around 8,000 units per annum. So I think we have to look at this space from a longer term perspective rather than a next 1 or 2 year perspective. And Tesla coming to India, if at all and whenever it happens, it is going to be a positive for the overall ecosystem. Wherever Tesla has gone, it has increased the penetration levels of EVs in that country, because the overall ecosystem, the awareness around EVs, the charging infrastructure that gets developed around it is a positive for the overall EV ecosystem. And one needs to look at how this pans out over the next 3 to 5 years rather than next 6 to 8 months, even if there is any delay in Tesla coming to India.
Okay, got it. I want to talk about Chinese automakers and the big threat there, right? Understandably, Chinese automakers are a big threat to the auto industry in the US, that is the EV industry there. But is it fair to assume that China is a big threat to India as well? I mean, I was looking at some data, right? The price gap has widened considerably. The average retail price of an EV car in China is now less than half the price seen both in Europe and the US. What does this mean for a market like India?
I think Chinese are, something that we really need to watch out for from a global perspective. Also, I think Chinese have the potential to disrupt many of the global EV makers as well. And we've seen that them trying to enter into Europe, US. Of course, there are a lot of tariffs on Chinese players. In India, that's something that we need to watch out for. Definitely, government has put on hold the Chinese investments of BYD. We've seen reports of that as well. Chinese EV ecosystem is well established. The cost structures are much more competitive than the global players. Their technological innovation on manufacturing of EVs is far ahead than many of the other global players. So definitely that's something to watch out for. And if it enters India, it can definitely make a big impact. Barring the brand aspiration of Chinese players is something that is yet to get established in India. But one needs to see how the political scenario plays out as well, because how Chinese enter India, whether it's into partnership, because probably they may not be able to enter on a standalone basis, is something that needs to be seen. But definitely there's something Chinese players are yet to be, are keenly watched out for in terms of competitive scenario.
Okay, let's also talk about stocks before we head to the next guest, because at the end of the day, for our viewers, that's what matters. A quick comment there, Jay. You were saying that a lot of new participants now entering with, not new participants, but a lot of new launches expected in the next 1 year from the likes of M&M, etc. Tata Motors is the top player in the market right now. Which is the next, competitor that could give a strong competition to Tata Motors in this space? Because stocks like M&M, etc., are already sitting at fresh 52-week highs. Do you think they can build on to these gains?
Yeah, I think, new launches that are expected, apart from Tata Motors, which already have a decent enough of models in India, the next leg of new launches is expected to come out from M&M. The next year, probably we'll also see Maruti. We'll also see Hyundai, Kia. So, the top 5 players of the passenger vehicle industry in India, only one of them has a meaningful presence in EVs in India. And I think over the next 12 to 18 months, you'll see the other 4 also incrementally coming with EV launches. So I think this space is expected to get heated up, currently at very low penetration levels, but expected to move up going forward with incremental launches.
Okay, so on M&M, what is your target price, and on Tata Motors as well?
Yeah, so we have a positive rating both on M&M and Tata Motors currently, and we'll be reviewing our target prices closer to the earnings season.
Okay, we have Anil Srivastava now, the former principal advisor at Niti Aayog, joining in. Mr. Srivastava, thanks a lot for joining in. I just want to understand from your end, what is the impact that the new incentives provided by the government would have on the EV ecosystem? Because as we were just discussing with Mr. Kale as well, the EV penetration, despite everything, is still so low at barely 3%, right, in the passenger vehicle space. What has been done so far which could help increase penetration, and what more do you think needs to be done on this front?
Good morning. Well, the penetration is as per our expected lines. The EVs are picking up pretty well and pretty fast, and that's what was expected by the government when we had started making projections in 2017 about the 2030 and further from there. So it's moving in the right direction, and I'm very happy to see as to what we were planning. The events have started unfolding in the right direction. Now, the incentives have played a very critical role. The FAME 2 which we drafted, it's played an important role in promoting the EVs in the two-wheelers and the three-wheeler segment. And from there, I think we have now started moving towards the personal vehicle segment. Now, what more needs to be done is that the government has been extremely proactive in taking forward this electric vehicle movement. But along with that, now the government has to move forward even faster. And one very critical thing is the standardization, which is very much needed. And that is probably will give a lot of consolation and brought a lot of relief to the buyers, in the sense that you have to have the standardizations in terms of the batteries, in terms of the charging protocols, and so that the swapping policy, which has been not announced after being introduced, but it is not finalized, that may also take shape, number one. Number two, the Indian buyer is very circumspect, and I still feel that there's tremendous scope for having an appropriate vehicle for the Indian buyer and the Indian segment. And that is very much needed. We need to have a vehicle, yes, in the upper segment. Yes, there are models which are coming into India, but in another 2-3 years, we will have a large number of personal vehicles in the market, which will be a big relief to the buyer. For the two-wheeler and three-wheeler segment, we have already crossed over the tipping point, and the adoption is pretty quick. But there again, the opportunities which are there for the startups and the new companies are tremendous. I would say that the sky is the limit, and the open field has been provided for the companies to come forward and provide, make the goal. So this is something which is there. The disruption which is taking place in the automobile sector and in the mobility sector is impacting the life too much. That's
Got
what
it. You made sure, Mr. Srivastava, you made an important point about how the Indian consumer is rather price sensitive. So bringing the price point lower is something that a lot of the OEMs are looking at. That's one thing. The other thing is range anxiety, right? Charging infrastructure is something that has also dissuaded a lot of people, or rather the lack of the charging infrastructure has dissuaded people from switching to EVs. Do you think enough has been done on that front, and what more do you think the government can do?
The prices will come down automatically. The battery prices are coming down. The battery, which comprises about 35 to 40% of the price of the EV. And as we had projected, even it has come down from the $100 per kilowatt hour further down. So the prices are bound to come down, and they will come down quickly. And it's very clear, you have a better product. That is what you have to sell. That is what you have to pay, make the people familiar, and you have to sell a better product, which is extremely easy to my perspective. So the prices are certainly going to come down. Now the range anxiety, as I understand, is not really an issue, because the charging speeds are going up, and there are fast chargers. A lot of research has gone into it. The fast chargers, there are chargers which charge a vehicle within 15 to 20 minutes of time. But yes, of course, if you want to charge it at home, then you have to have a slow charger, but you can always have a fast charger as well. So the charging range anxiety is certainly there, because we have not been able to create the infrastructure, and that is where, again, the government has to have a policy where the government has to provide the proper environment for the startups to have the charging infrastructure all along the roads in the cities and the highways and everywhere for that matter. There are a large number of startups which have come up in the areas of charging infrastructure, those who are working, and they are, doing an extremely good job in the sense that announcing the things and taking up the thing, installing the charging station. But yes, it has not yet reached to the point where as a buyer, one would be comfortable in buying an electric vehicle. So that is
Correct.
something which is happening. And yes, the government needs to have the standardization for the charging protocols and then provide support for setting up the charging stations. That is very much needed, but it is a kind of a non-issue because the charging speeds along with that are also going up. That is also true.
All right, fair enough. Very valid points made there. We would have loved to chat some more. We'll do this at another time. Jay and Mr. Srivastava, thank you so much for joining us and putting the spotlight on, the Tesla, of course, the possibility of Tesla disrupting the Indian EV market and what the EV market could grow to from here. Well, for our stock markets, it's looking pretty good. Still holding actually with gains of almost 80 odd points. When we come back from the break, we'll get you excerpts from our conversation with the management of RHI Magnesita on their business going forward. Later, we'll also put the focus on chemical space in our segment Quarter Se Quarter Tak. Stay tuned.
Welcome back. Well, we started gap up, but from the highs, actually, we've come off considerably. So the high of the day is around 22,340 approximately. We've come off 100 points in the Nifty Bank. That's the one that's come off close to around 200 points as well. Well, let's focus on RHI Magnesita. I spoke with the global head, Mr. Stephen Borges, as well as India business head, Mr. Parmod Sagar. I started by asking them about their capex plans in the backdrop of Vesuvius going ahead and upping their capex to around 1,000 crores here in India. Let's listen in to what they had to tell me.
We are way ahead of the game, of course, because we've already spent a huge amount of money. If we take everything together that we're going to spend on the region here, it's around 450 million US dollars worth. I think, according to my calculation, this is about 4,500 crore. So this is the total package in the short term, but including what we have already spent. So we're way ahead here. We have now bought all the capacities that we need for the next years. We have still the need to build some capabilities now. So there's a lot of technology investments that we will do. We have a collaboration with a Japanese refractory company to build technologies and to bring this to India here. This is happening very soon. We're building up our iron making capabilities here, where we were not present until very recently. We are very much focusing on circular economy capabilities. So here, this takes a lot of infrastructure investments as well in order to bring this circular economy addition here. And we're, of course, leveraging the Indian IT capabilities, the IT capabilities of the country for two reasons. We're building programming capabilities, software capabilities, and we're bringing all the global services from all of our other regions to India in the next 3 years.
Okay, all right. So quite interesting. So $450 million is the ballpark number that you've laid out in terms of capex that you've spent, and what you're going to spend going ahead as well. So we got that point.
This includes the money that we're going to spend.
Got it. And from here on, out of that 450 million, how much has already been spent and how much will be spent?
Yeah, about 80% is already spent.
80% is already spent. All right. So that's why you're saying that you're well ahead of the curve. Give us a few more details then. In India, the steel consumption is expected to grow in double digit, very, very roughly. Could you tell us what kind of growth do you see for your industry here in India? And if I go via revenue matrix, you'll have close to around 33% of the market share. Where do you see this number headed?
Well, the market share focus is not really the number one focus, but with the addition of the technologies that we will add in market segments in which we're not now in steel and also outside of steel.
Okay.
Not to be forgotten, refineries, cement, glass production, copper production, all this is growing in the region. Our market share just by default will grow to little short of 40% in the next years. In India, on the steel side, we have to differentiate between steel production and steel consumption. We have a large percentage of imports into India still, especially from China. This will continue unless there are some drastic measures. Therefore, the steel production in India is around 6-7%. The production growth 6-8%, and this will be the growth of our business as well.
Got it. What about the export strategy? You'll have made this point that you're looking to get into markets like East Asia as well as Africa. I think currently the total exports are roughly around 11 to 12% of the total mix, and you'll want to take it to around 20%. What kind of progress are you making on that front?
Yeah, this is a very interesting question because we have to look at this from two perspectives. There's the outside-in perspective. 3 years ago, RHI Magnesita was importing 80% of its materials. Now we are already producing 60% in the country, so from 20 to 60, and this will go to 80%. Self-sufficiency inside India for India. On the export side, we have a very small export percentage of maybe 6-7% 3 years ago. This is now at around 12%. This will go to 20% in 2025 and then to 30% in maybe 27, 28. So India will become a manufacturing hub, but not just for the region, but for the entire world.
Okay, got it. Quick counterpoint before we get to Mr. Parmod. As of now, the total royalty that is paid, I think, of the listed entities is around 2%. Your peer is Vesuvius. They pay close to around 3%. Do you see there's a possibility that there is a tweak in the royalty rates as well?
Well, it depends very much on where the technology comes from and how this develops. We don't have a royalty planning scheme. It's just a default from what will happen with the technology that we bring here. So it could very well increase slightly.
Okay, and we could hear that decision in the coming fiscal, that's FY25?
No, it's not a decision. This is a default of, it happens product by product, technology by technology. There could actually be some royalty income also if we develop technologies in India here later on.
Oh, interesting. So we'll see how that goes. Final question to you, Stephen. We have a big investor in there by virtue of the inorganic growth. The Dalmia Group has close to around 13% stake in the company. And reports indicate that maybe they could be looking at selling that. If that is true, would the parent be interested in picking up that stake? You'll have already pumped in some money, but that's the big overhang on the stock from an India market perspective. Your take?
Yes, they have always made it very clearly that this is not a very long-term investment. They are, of course, very intelligent and savvy investors, so they will do this in an intelligent way. So from an investor perspective, I think nobody should worry here. This will be block trade, so it won't be a real overhang for the stock. If the price is right, of course, as a group, we will always consider. But at the end of the day, of course, you need to ask our shareholder themselves of what they want to do.
Interesting. All right, Mr. Parmod, let's come across to you then. The utilization levels of both the acquired assets haven't really lived up to expectations. Give us a number. In the coming year, how do you see both these two acquisitions shape up? What is the rough utilization levels we could look at for FY25?
As of now, I think we are at about 60% level, and I believe in next 3 years we should reach to 75 to 80% utilization level.
For high tech as well as for Dalmia?
Yes, both.
All right. There was some refurbishment that you were taking on, particularly at Dalmia. What is the total money you have earmarked for that? And how is the progress out there? By when can we see the fruits of this particular investment?
First of all, this year we were trying to see how much is the low-hanging fruit without investing too much money. If we can leverage, we can improve our productivity, improve working conditions, and then invest money. We already started investing money, and I think in the next 3 years we will be spending something like 250 crores to 300 crores.
Okay, got it. Also, because of the consolidation in the refractory industry, I think you all have mentioned on your con call as well that it resulted in losing some kind of share from a client like, say, SAIL. What are you all doing to get this market share back?
Actually, earlier it was 3 companies, and Steel Authority of India is having tender-based system. So 3 companies was bidding for one particular tender. So now it is 1 company. So it was anticipated. We were aware that we are going to lose 2-3% of this business. But at the same time, we start working on how to mitigate that. What are the products which we are not selling to Steel Authority of India? We start trying those products in Steel Authority of India, and the results are very encouraging. And I believe we will be overtaking. If we are losing 3% business, maybe we will compensate that 3% and increase rather 1 or 2% more.
Okay.
That is not concern.
Okay, final question before we let you all gentlemen go, Stephen as well as Mr. Parmod. Any more inorganic plans for the listed entity? You'll have done a fair bit on ground. Is there more inorganic plans? Do you all have the appetite?
Yes, we have the appetite. There are always inorganic plans.
So we could see more inorganic from the RHI listed entity here in India in the coming fiscal. Are you all on the prowl?
Whether in the coming fiscal, I can't promise, but for sure it's possible that this will happen.
All right, well, let's move on to our special segment now, Quarter Se Quarter Tak. Sonal is joining in to tell us everything that you can expect from chemical companies in Quarter 4. Sonal, over to you.
Thank you so much for that. Well, Quarter 4 for chemical sector is going to see a sequential recovery. YY, however, will be largely weak. Dumping from China has continued due to lower demand in that region, which has continued to impact global realization. There are green shoots in certain end-user industries such as dyes, pigments and polymers as well. Now, this is for chemicals, but agrochemical demand continues to be under pressure. But is recovery in sight? Well, not in the near term. Kotak Institutional Equity says recovery remains elusive and expected to take at least 1 to 2 quarters. And Elara says that price recovery will take at least 2 quarters. Now, for chemical companies, let's look at expectations. These are the estimates from Kotak. Aarti Industries is expected to see profit decline of 15% YOY, but it is expected to be up sequentially. For Atul, profit expected to decline 11% YOY, but up 17% sequentially. For Naveen Fluorine, PAT down 65% YOY, up 14% quarter on quarter. SRF should see PAT down 26% YOY, but up 64% sequentially. And when it comes to Tata Chemicals, profit is expected to decline 82% YOY and down 18% sequentially. So commodity chemical company here and soda ash prices, they continue to be lower. Vinity Organics, that will see PAT down 28% YOY, but up 8% sequentially. And the management did indicate to us that worst is over in terms of business fundamentals. Moving on now, for agrochemicals, no recovery will be seen. UPL, the biggest agrochemical company, will see a loss yet again, though losses will come down sequentially. Double-digit price erosion will be seen. PI Industries will be an exception as always. It is expected to see profit growth of 50% YOY, but that will decline 6% sequentially. Growth will be led by scaled-up revenues from new products. Let's leave you with the valuation picture now. It continues to remain elevated across names. Aarti and Atul with similar end-user profile trading between 41.6 to 46 times. We have SRF and Naveen Fluorine trading anywhere between 38 times to 48 times. Tata Chemicals trades at 28 times. Vinity Organics is 39 times. And PI Industries at 32.5 times.
Right, Sonal, thanks very much for that sort of comprehensive wrap out of what we can expect from the quarter. Let's get an analyst in as well. Ranjit from IIFL is with us to take us through, the expectations as they stand right now. Ranjit, good morning. Great to have you with us here. Prashant this side. So let's just start with, which parts do you think will see, as Sonal outlined, agrochemicals perhaps no real recovery expected, but to your mind, what's got the best chance and the fastest chance of a revival? And, on the other side, is it agrochemicals? Is it something else? Just sort of describe the spectrum for us, because chemicals is really many sectors there.
Yeah, Sonal has, first of all, thank you for having me on the show. Sonal has kind of beautifully put this. So if you kind of see the chemical sectors, the primary or the major user industries is AgChem, which is under a cyclical slowdown at this point of time. And here we have seen a significant pricing erosion that has been impacting the generic players. As far as the specialty chemical is concerned, the ones who have a contracting kind of a mechanism are still able to do well off. So the way we see it, if you look at probably we are calling it as an improvement and not yet a recovery at this point of time. We are also of the same view that it will take at least 2 quarters to kind of see a bit of a recovery in the sectors. At the same time, while we are seeing the valuation remain expensive, and that was kind of makes us a bit more cautious on the sector. 4Q will definitely see an improvement sequentially, because 3Q was really bad for the entire sector, where we have seen order deferrals. So 4Q, we will have those orders coming, bunching up, and then we'll see a bit of a seasonality hitting the sector. So that's how we are seeing it. 4Q will be a better off, but calling it a recovery is still a bit early. probably we will still see a bit of an improvement. I think 1Q is what will give a bit of a flavor where this momentum is continuing or not.
Okay, all right. Hi, Ranjit. Good morning and good to see you. And we had the management of Vinati Organics, and they were sounding quite optimistic about the outlook. And managements, they're perfectly justified in sounding a little bit more optimistic, so good on them. But given that you as well are sounding that you're factoring in some kind of recovery from the next quarter onwards, which is the stock that will be top of mind focus?
So I don't cover Vinati actively, so to that extent, I won't be able to comment on that. Again, when it comes to stock-specific picks, as Sonal has kind of pointed out, the valuations are anywhere between 28 to 30 times. So that kind of caps upsides, at least in the near term. But since we believe the story is more structural, so to that extent, one can still wait for a bit of a correction and then enter. Again, here coming to stock-specific, we have seen the likes of SRF has been doing well. Yes, there are a bit of a near-term headwinds. So probably one would be able to kind of tie through or see through that. And at a right price is what we'll again look at SRF.
Okay. What are the other stocks that you track, in this entire space where you're bullish on for the medium to longer term and you expect good numbers this time?
Yeah, on the stock specific, if you look at probably the valuations is what one of the key things. As I said, most of the names, we do have a structural positive. And if you look at the estimates, we are building an at least 30% CAGR from a 24 to 26, at least 2-year CAGR of 30%, which is a very strong number. So based on those numbers, when we see the valuation as 28 to 30 times, that do calls for a bit of a cautiousness, at least in the near term. Once we'll start seeing a very strong recovery, that would be probably the right time to kind of go a bit more positive on these sectors. So the stocks which are probably a bit more compelling on the valuations is what we are a bit more positive on. So one of the stocks that we would like to highlight is an RHI Chemical, is still probably a low mid-teens kind of a PE, and there the story seems to be more structural, where we are seeing them from a main commoditized kind of a business. They are moving over to more of a value-add business. So probably that is what we continue to have a buy rating on.
That's that one, Archean Chemicals, 685, your commodity play, but as you said, moving away from commodity to more specialized chemicals. Value-added segment, and valuations are attractive, as you said. What else, Ranjit, if you want to highlight? One or two more names.
Yeah, it's difficult, as I said, 28, 30 times. Valuations would definitely be what restricts me from giving out any top picks from this space. But as you said, this is more of a structural. Probably in a quarter's time, we will see that if things are started to return, we will definitely have more names.
Yeah, no, I mean, it's always difficult to buy just in time. So if it's about a quarter,
right.
The
thing is that if you look at even the global insights that we have been tracking, has been kind of expecting a bit of a recovery from the second half of this calendar year. But again, what we have seen that it remains a bit of a optimistic, and we haven't yet seen any recovery in the prices. So that is what kind of restricts me to not to put out any names at this point of time. As we kind of gain a bit more confidence, yes, there are a bit of the thing that we are tracking is the pricing action. And if you look at most of this pricing action are still kind of 20-30% down. So even if there is a bit of a volume growth in the sector, the pricing action is what will kind of limit the EBITDA growth. And that's where we still see a bit of a risk for FY25 and FY26 numbers. And that's what restricts me from putting out any names at this point of time.
All right, Ranjit, we leave it at that. Thanks a lot for joining in. Let's slip into a quick break. On the other side, Brent crude prices have fallen 3% last week. Some more discussion on that coming up. Manisha Gupta will join in to talk about that. Stay with us.
Okay, welcome back. A third of a percent higher off the highs, but 78 points on the index. Mitesh is back with us. Mitesh, not exactly giving up everything, but off the highs by a decent bit. What's the trade here on the index?
No trade, Prashant. So actually, the idea is that the reversal which happened on Friday kind of negated the downside possibilities, and we haven't got signals of the index moving on the upside. So I'll wait for the Nifty to either get past today's high of 23,337 or 23,340 or have an hourly close about 22,300 to take some long position. If that doesn't happen, then we'll just chop around in a range. So we in kind of a wait and watch mode when it comes to the indices. On the stock side, though, I have a sell on Persistent with a stop at about 37.55 for targets of around 35.60 on the downside. And the stock which I like, and disclaimer, we have a buy call here and recommend it to our clients as well. It's Petro. That's a buy with a stop at about 490 and a target of roughly around 520 can predict that.
Okay, by the way, if you're wondering why Persistent is down 4.5%, they had a conference call where their margin guidance has disappointed the street. They've spoken about how the guidance for the margins will be flat in FY25. And they also speak about how the next 12 months will be quite challenging in terms of a macro environment. But their goal is to maintain a top quartile growth while maintaining margins at current levels. So a little bit of disappointment coming through for Persistent Systems. Thanks, Mitesh, for joining in. Let's shift focus now to the commodity markets. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, there's one area which has continued to gain, and that has been base metal prices. And within that sector, it's copper prices holding around that 22-month highs. We have seen prices from a low of this year of $8,900 come up to $9,800 a ton on your screens. So we have seen prices gain up by 4% in the previous week, and it's 14% up in the last 1 month itself, clearly leading the rally there. And if you look at the copper as a barometer for economy, well, you have seen strong numbers come in for this one. The latest data today, the China holding loan prime rate steady is something that the street was anticipating after the move that we saw, especially in the month of Feb. But there are various other reasons for the copper prices to continue to surge higher. There have been large capital inflows within the commodity. We have seen those reports of output cuts, raw material shortages are key drivers, the reason that the prices have been trading on the higher side. Also, the green energy transitions has fueled the demand going forward. That is what the estimates are doing right now for the prices as well. The sentiment itself has been baked into the prices there. Demand from AI-related electric equipments, data centers has been on the stronger side. The street also is looking at China copper smelters, where they have pledged an output cut of 10% in 2024. The output cuts in various mines is something that continues to grow in sense of a list there. Zambia mines have been shutting output because of power shortages there. You have Panama's Cobre mine shutting down. South African mines have failed to meet their 2023 guidance itself. And various mines, whether it's Codelto and Antofagasta, have been cutting production in the first quarter of 2024 itself. And that is weaving its way in case of prices. Also, take a look at the kind of hedge funds and money managers long positions that have built in copper on the back of fundamentals. That is at multi-year highs as well. So there is a very bullish view going forward in sense of copper. Trafigura, which is one of the largest brokers of copper in the world, says that there is underinvestment and they do see a deficit of a larger quantities by 2025 and 2030 as well. There also are experts suggesting that 5 to 6 million tons of deficit is what you could see going forward. Demand in AI is also estimated an additional 1 million tons by 2030, and we haven't seen that kind of copper supplies come into the market. Add to that the kind of reports that we've been seeing from Citi and Bank of America talking about $10,000 a ton of copper in this year and an all-time high of $12,000 in the next year as well. That is what is keeping a lot of people interested and holding longs in this space.
Manisha, thanks very much for that. So copper is doing very, very well. Calls for shortage, bigger shortage into 25. We'll take a quick commercial break here. We'll connect with Sunil Vaswani, Executive Director, Container Shipping Lines Association India, Ajay Sahai, Director General and CEO at FIEO, to discuss the impact on shipping industry amidst the flare-up of tensions in the Middle East. Stay tuned. Welcome back. 100 points on the Nifty. Things are looking pretty good with an hour behind us this Monday morning. Now, the ongoing Iran-Israel conflict has raised concerns in the global maritime industry, causing supply chain disruptions. Shipping container rates have surged between 40 and 50% on a year-on-year basis. Let's talk about this more and whether this is going to worsen. Ajay Sahai is Director General and CEO at FIEO. Mr. Sahai, good morning. Great to have you with us here. Thanks very much for your time. I mean, that part of the world has been not on the brink, but it's kind of been seeing a bit of upheaval for the last year or so. And now, of course, the fact that Iran and Israel looked like they were coming directly in confrontational mode, perhaps has raised tensions. But the impact on freight rates, etc., Mr. Shah, if you can just sort of put this into context for our viewers.
So in fact, for last 1 year or so, we are seeing huge challenges in the logistics, particularly after the Red Sea crisis. And we were hoping that Red Sea crisis may diffuse, but with the Iran attack on Israel and counter-attack, which has been reported by Israel, the situation has definitely aggravated, and it has resulted in some disruption of the shipping also. Shipping freight were already very much elevated. They are further expected to go up, and so has been the insurance. We are watching the development very carefully, because if Iran stops the Strait of Hormuz, probably we may see some impact on the global oil and gas prices, particularly on the LNG prices. Global oil prices have already moved up, and they are expected to go up further. On the logistics front, we are expecting much disruptions, and in fact, a lot of exporters, they have already delayed the shipments. Much of the shipment which were expected to go in the month of March, they have been now moved over to the month of April, and to some extent to the May also. So it's extremely very worrying situation, and we are concerned with the development. We hope that the global diplomacy will prevail. The two sides will come to some kind of agreement so that there is ceasefire, and ultimately the situation can be diffused.
Okay, the situation can be diffused. But in the event that the Gulf of Hormuz is shut, right, there is this worry that if things escalate, then the Gulf of Hormuz will be shut. But if that happens, what do you think the implications would be? And what are the alternatives now?
In fact, if the Gulf of Hormuz is set up, I think the problem will be with respect to the LNG supply, particularly from Oman, because there is no other route available. For other countries like UAE and Saudi Arabia, they may be using the alternative routes. Maybe the Red Sea. If the Red Sea is not working, everyone is going through the Cape of Good Hope, but definitely it will increase the cost significantly. Secondly, as of now, the Strait of Hormuz, they deal roughly with the 20% of the oil and gas cargo. Whether the other route will be able to accommodate that is also an issue. So in the given situation, we are looking into a northward movement in the prices of oil and gas. It may not impact India to that extent, because we have the option of increasing our imports from Russia. But I think the global oil and gas prices are all set to move up.
But the impact is largely on oil and gas, right? As you said.
Yeah.
Not on container shipping, etc.
No, definitely container shipping, in any case, they are much elevated and they are expected to go up. We are worried about not only the cost, probably there will be much disruption in the shipping schedule also. In fact, just after the Red Sea crisis, the shipping schedule has got haywire, and exporter is struggling to provide the timely delivery, and much of them have already moved to the air shipment, and air freight in the last 6 months or so have gone up to some destination like Europe by 400%. So this is extremely concerning. This is extremely dangerous trend, and we are hoping that it should not diffuse further. The world is just coming out of the COVID crisis. We have already suffered Ukraine-Russia war. There is a Red Sea crisis, and probably this is going to give a huge jolt to the global trade and the global economy.
Okay, so what is the impact that you've seen on Indian companies so far, both in terms of overall business as well as freight rates?
No, of course, because of the high freight rate, the bottom lines of the companies have been impacted, and so far exporters have been able to absorb that. The new contracts have been negotiated, and luckily both the sides have agreed to bear a little bit of punch, and that's why we are not expecting exports to be impacted. But point is that if this escalates into a war, then the entire Middle East trade may be impacted, and Middle East is extremely important for us. Roughly 22% of international trade happen with the Middle East countries also. So we are just hoping that the Israel and Iran comes to some kind of conclusion, and there is a ceasefire now, because if Iran further escalates it, or if Israel further escalates it, it will be huge blow.
Okay, we have Sunil Vaswani, who's the Executive Director at Container Shipping Lines Association, who is also joining in. Mr. Vaswani, thank you for joining the conversation. At your end, how are you reading this entire situation? both in terms of what the impact would be if this escalates, if the Gulf of Hormuz shuts down. What is the kind of cost escalation that we're looking at for the industry and for your own, for your own association?
Yeah, all right. Morning and you. As things stand currently, the countries like Saudi Arabia and Egypt are already impacted because of the practical closure of the Suez Canal and the Red Sea and the Bab al-Mandab due to the Houthi rebels. Now, if this escalates, then you could have a risk of the Persian Gulf and the Strait of Hormuz also getting impacted or practically closed for that matter. And if that happens, a country like Saudi Arabia will be particularly impacted because it will be shut on both sides. So supply chains will definitely be impacted there. And also in countries like the other countries of the Persian Gulf would have problems, and particularly as far as the imports are concerned of essential commodities like pharmaceuticals, foodstuffs, etc. Fortunately, as it seems that the response from Iran to the Israeli last Israeli attack has been rather muted, verbally muted, and there has been no further action on that. So that said, it gives some confidence that hopefully the situation will not escalate. But in the meanwhile, but if it does, of course, then even the oil supplies and all that will be impacted. But in the meanwhile, the insurance costs have already gone up as far as the shipping lines are concerned. The war risk premium earlier used to be 0.05% of the value of the ship. Today has gone up to 1%. So for a vessel which costs about $100 million, which is quite common for a ship, in fact, most ships even cost more. Straight away, $1 million is the cost of the war risk premium that is applicable. And though currently the situation in the Persian Gulf seems quite okay, but it is quite clear that any vessel having the remotest of connection with Israel could be the target. Also, as far as the disruptions are concerned, one must bear in mind is that different sizes of ships and different configurations are available for different trade routes. And this constant disruption kind of, forces us to, interchange those vessels, and then getting the right size of the vessel or the right configuration operationally as well as commercially in a new route becomes quite challenging. As things stand, there has already been a certain amount of disruption as far as Europe and the US East Coast and Latin America are concerned because of the diversion over the Cape of Good Hope. Obviously, this has increased the cost as far as the capital expenditure is concerned, charter hire is concerned, feedering cost is concerned, crew cost is concerned, fuel cost is concerned, etc., etc. So, for instance, if on an earlier leg, same leg to Europe, if you were operating via the Suez Canal, a service with about 9 ships would take 63 days for a round trip. Today, going over the Cape of Good Hope, you need to add 3 more ships to be able to maintain that schedule, which is a weekly schedule, which was originally a weekly schedule. And that round trip takes 87 days. So what is happening is that we are putting in additional capacities, which is costing us additional capital expenditure. Also getting ships, at such short notice with frequent disruptions is quite a challenge, either internally through your fleets or through chartering from the market outside, and the charter cost goes up. And eventually what happens is that, and one last point, that like for instance to the point that's happened to Europe that we are talking about is also some of the ports that were earlier serviced directly, particularly to the East Mediterranean ports, those are now transshipped via feeder vessels. So the feedering cost goes up, and of course the transit time increases. But the good side of it is that we've tried to shorten the trip for those direct vessels, So which means to North Europe, your transit time improves by about 5 to 7 days. So these are the kind of technical things that one has to manipulate with these frequent disruptions. Thank you.
All right, we're out of time, but fascinating always to talk about global shipping and the complexities of it. Mr. Vaswani, thank you very much for joining us. Mr. Sahai, it's a pleasure. And let's hope, fingers crossed, that things don't flare up once again and they quieten down and get better going forward. But I think we have to also sort of be cognizant of time here. We are completely out for now. 90 points is what the Nifty has got, 22,235. And it's an up-looking market, but it's off the highs by a decent bit. Market breadth, by the way, is still very strong, almost 4:1 in favor of advances. So the broader market doing much better as compared to what the index stocks are doing. But more is coming up. It's a wrap on Bazaar here from Sonia, Nigel, me, everyone on the team. Goodbye. But Chartbusters will pick up on all the action in just a bit.